Good morning. Uh, So, ladies and gentlemen, a warm welcome to all of you. The wide registrations today, almost 400 online and offline, shows the need for programs like this to better educate ourselves about what are the current requirements on the audit report revised format and how we must engage. Charitable organizations are essentially formed to benefit the public at large. The NGOs help address a wide variety of social needs through various means and are working in the areas of providing relief and assistance to people at times of need in any part of the world, especially to those who are victims of war, natural disaster, catastrophe, hunger, disease, poverty, and those orphaned by supplying them with food, shelter, medical aid, education, and other fundamental needs. In the times of the COVID pandemic, charities have supplemented the government's efforts to alleviate the problems faced by its citizens. Unfortunately, in India, charitable organizations are highly regulated, and there are constant changes being made to the Income Tax Act 61 and rules, including several amendments in the Finance Bill 2023 for the purpose of taxation of charitable trusts. The new reporting requirements cast a much larger obligation on the auditor, who is now required to report on the objects and operations of the institution, including detailed reporting on contributions, application of income, taxability under Section 115 BBI of the Income Tax Act 61, capital asset transfers, transactions with specified persons, and violations. The seminar has been organized by the IMC's Direct Taxation Committee jointly with the Bombay Chartered Accountants Society and the Chamber of Tax Consultants to explain the nuances of the reporting and issues and complexities likely to be faced by the charitable institutions and auditors. I would like to welcome CA Sonali Godbole, she is almost here, partner Kalyaniwala and Mistry LLP, CA Gautam Nayak, partner CNK and Associates LLP, and CA Anil Sathe, also almost here, partner Gokhale and Sathe, chartered accountants, for sparing their valuable time for this seminar. Established in 1907, the IMC, having its headquarters in the heart of the city of Mumbai, the Chamber of Commerce, IMC Chamber of Commerce and Industry is an apex chamber of commerce, trade and industry in the western region with its membership base of over 5,000 members and over 150 trade associations affiliated to it. Together, it represents and advocates the interests of over 4 lakh business and industry establishments across the country from diverse sectors of the industry. It has 19 industry-specific committees of experts through which it provides policy inputs and recommendations at various levels of government and organizes activities where eminent business and government leaders engage with its members on a wide range of issues to create an environment for sustainable economic development. I would like to add, we have created a specific committee for dealing with issues of non-profits. We do believe that it is a place and a need to engage with the government at the states and the central level to explain the particular needs and how we can constructively work together with the government to meet the larger objectives of the country and the world. The IMC International ADR Center offers institutional arbitration of disputes in international standard facilities and established rules and panel of arbitrators. Our state-of-the-art venues available for hire are catering to various sizes and are equipped with Wi-Fi and video conferencing facilities and have been made COVID protocol compliant. We are authorized by the Government of India to provide the issuance of Certificate of Origin for exporters, and this service has also been made available online with digital stamping and signing features. Once again, I welcome you all to this interesting event. I am sure you will go back enriched, and I welcome you to join the IMC to help supplement and strengthen our work in understanding the needs of this sector and engaging with the government constructively to help further our own objectives and those of the nation. Thank you very much. Chirag bhai.
Yeah. A very good morning to everybody. Respected CA, respected Mr. Samir Somaya, President IMC, CA Haresh Kenya, President CTC. Today's speakers CA Sonali Godbole, CA Gautam Nayak, and CA Anil Shate. CA Rajan Vora, I think he's online. CA Deepak Shah, past president. A very good morning to everybody. I think Samir Bhai has very well covered the gamut of charitable trust, the importance of it, and the dynamic nature of charitable trust laws which are happening today. And we see that with the kind of attendance we've got for this event. I would, since there are a lot of non-members from BCS, I would directly like to introduce BCS to all the participants here as well as online. Friends, Bombay Chartered Accountants Society is India's largest and oldest voluntary professional body of chartered accountants. It has a membership of exceeding 10,500 individuals, and it's widespread spread across India in 250 plus cities and towns of India. BCS is unwavering in its commitments towards the development of the profession since 1949. We've entered our 75th year of existence this year. BCS core mission is to provide its members with extensive opportunity for growth and advancement through multifaceted approach encompassing learning events, research publications, advocacy, networking, and community initiatives. By operating as not-for-profit organization, BCS relies on dedicated efforts of hundreds of volunteers who selflessly contribute their time and expertise while upholding shared values and professional ethics. A pioneering thought leader and a community enabler, BCS continues to play a pivotal role in strengthening the accounting, tax, finance and economic fabric of India. BCS does all these things through various seminars, lecture meetings, workshops, refresher courses, study circles. It continuously tries to upgrade the skills of the professionals and make them stay updated on the industry trends. BCS has its monthly journal, which is one of the most sought after journal since over 5 decades of its publication. BCS has a comprehensive approach to professional development combined with its community focus initiative, enabling a more robust and a sustainable future. With this, I would also like to introduce that since BCS has entered its 75th year of its service to the community of chartered accountants and society at large, there are several events which are planned throughout the year, but one of the mega event which is planned is on January 4th to 6th at Geo World Center, Mumbai. This 3 days of Manthan will have a lot of public events and community activities. It has series of it has series of presentations, thought-provoking discussions, panel discussions, fireside chats for the future and dynamics of our profession. I would like to invite all of you to come together and make that program, which is a 75th year celebration for our association as well, as one of a grand success. The registrations are open and you can take the benefit of early bird as well. Thank you everybody, and with this I think I'll hand it over to Harish Bhai.
Thank you. Thank you, Jia. Thank you. Respected Samir Bhai, Chirag Bhai, respected office bearers of the IMC and BCS, and Rajan Bhai and other seniors, ladies and gentlemen. A very good morning to all of you. I am truly delighted to be here today as the President of Chamber of Tax Assistants, representing an association that stands for excellence in the field of taxation. First and foremost, I want to extend my warm welcome to all of you to join seminar organized by the Chamber, IMC Chamber of Commerce and Industry, and the Bombay Chartered Accountants Society. It's heartening to see that this collaboration among esteemed institutions, which undergoes our commitment to fostering knowledge, sharing, and professional growth. Today's seminar focuses on the revised format of audit report for reporting by charitable institution. Center of Direct Taxes introduced these new reporting requirements, which came into effect from the 1st April 2023. The revised format places a large obligation on auditors, requiring them to report on the objects and operations of the institution, including detailed reporting on contribution, application of income, taxability, capital assets transfers, transaction with the specified persons, and violations. This not only impacts the auditor but also charitable institutions themselves. The intricacies of these negotiations might pose challenges, and that's exactly why we are here today. And to shed light on these complexities and provide valuable insights. Charitable institutions hold a vital place in our society, contributing immensely to various sectors. However, these financial and operational complexities have led to a need to more comprehensive reporting. The role of the auditors has become even more crucial in ensuring transparency and accountability. Our speakers today are expert in this field and ready to navigate through the nuances of these changes and provide guidance. Today, we have a privilege of having distinguished experts in our midst with who will take us to the complexity of the revised audit report for the charitable institution. Allow me to extend a special welcome to our speakers, each of whom brings a warm wealth of experience and insight to our discussion. We have CA Sonali Godbole with us, who will be shedding light on the intricacies of the revised audit report. Her expertise in this subject is bound to provide us with valuable insights into the key aspect of their new reporting framework. Additionally, we have the honor to have a dynamic duo of C. Gautam Nayak and C. Anil Sathe, who will be addressing these critical issues and complexities in relation to the revised formats of the audit report. Their combined experience and knowledge will undoubtedly offer us a comprehensive understanding of the challenge that both auditors and charitable institutions might face. As we gather to explore the understanding this vital aspect of the revised audit report, I encourage you all to take the full advantage of this opportunity. Engage with our speaker, ask questions, contribute to the engaging discussion that lies ahead. In spirit of the collaboration, I want to share glimpses of what Chamber of Tax Consultants stands for. As a Chamber of Tax Consultant, we pride ourselves on being the vibrant hub of tax professionals, students and experts. Chamber established in 1926, and for nearly a century we have dedicated ourselves to the encouragement of members' knowledge and skill. Our chamber is not just an institution, it's a dynamic community that thrives on learning, sharing and connecting. With a very array of workshops, seminars and the publications, we ensure that our members are at the forefront of our tax advancement. The Chamber Journal, a beacon of the insights, keeping our members abreast of the latest development in the field. But our purpose goes beyond information. It's about creating a network of professionals who supports and uplifts one another. Before I conclude, let me reiterate that this event is not just about learning, it's also about networking and building connections. Take this chance to connect with these fellow professionals, exchange ideas and broaden your horizons. Once again, thank you for being part of this event. And let's make the most of this day. We collectively seek to enhance our knowledge, insight and professional bonds. Thank you.
I would like to give a memento to our Sonali Godbole, Anirbhai Sathe and Gautam Nayak.
Should I start, sir? Yes. Good morning, friends. Now we come to the technical session. As you all know, we have divided this seminar into two technical sessions. In the first session, we have Sonali taking us through the important clauses of this large form, audit form, which has roughly 49 clauses to be filled by the auditor. And so she has identified some of the tricky ones, and she will take us through them, give us her views. As you all know, charitable trusts, very strangely in India is under a lot of focus, and as far as the Income Tax Act is concerned, there have been two recent landmark Supreme Court judgments interpreting the provisions. There has been these amendments in the budget. There are two areas of amendment. One is charitable trust and one is the International Finance Center in Gujarat. So these two occupy the major amendments in the budget for the last 2 or 3 years. And so charitable trusts become an important, and that I think justifies seeing the number of registrations we have, 300 plus, 325 virtually, and around 100 physically, and so that itself proves. Today, in fact, there are seminars by all the professional associations on different subjects, and this has amassed the maximum registration. So that proves the point that I think we are here for a scintillating day. So just to briefly introduce Sonali to you. Sonali qualified as a chartered accountant in 1997 with the 28th rank all over India. She has been, in fact, I have seen her even as a student, and she was always an extremely bright student. She cleared LLB in 2001, and she practices in the area of direct taxes for the past 25 years. She is partner at Kalyaniwala and Mistry LLP, which is a renowned firm of chartered accountants. She is member of the Taxation Committee and the Journal Committee of the BCA. She has written articles in Outlook magazine, IT Review, journals published by the Chamber. She has co-authored books on ICDS and TDS published by BCA. And she is a visiting faculty for taxation in the Management Institute and the Wellington Institute of Management. She is in Jamnamalal Bajaj and the Wellington Institute. So I think we have a very appropriate speaker, so to say, for the topic on hand, and without spending much time, I welcome her to give us her presentation.
Can you hear me? I think yes. Okay. Thank you, Sushil Bhai, for the introduction. Considering the time which I have at my hand, I directly come to the subject proper. Good morning to all of you. Now, today's session is basically on Form 10B, which has been recently introduced. As you all know, that Rule 16cc or Rule 17b of income tax rules mandates a trust to get the accounts audited and file the audit report in Form 10b, where the total receipts of the trust exceed the amount which is not chargeable to tax. So presently about 2.5 lakhs of rupees. Now this Form 10B, which was there up to assessment year 22-23, was on statute for many years, and it had compared to today's new Form 10B, very few requirements for disclosure. In that form, many of the clauses, the information which had to be given there was basically about the accumulation which trust has done or the expenditure which is incurred in one figure without giving any details. So this form, so to say, from the income tax department's point of view, was not giving them the information which they were actually seeking while assessing a trust. And then taking cue from new Form 3CD, which was introduced few years ago, a new Form 10B and 10BB was introduced by notification number 7, which was issued in February 23. And this form now, if you see 10B, the form is virtually on the lines of the form of 3CA, 3CB and 3CD, which has been introduced. It has lots and lots of information which the auditor has to give. At the same time, there is a form issued 10BB. This form is so-called a subsection of or subset of Form 10B because it has a lesser number of clauses, and so-called it is introduced for smaller trusts. So if a trust has gross receipts or income of less than 5 crores, it has not received any foreign contribution, and it has not spent any amount outside India, applied any amount outside India, then the trust can then the auditor can give audit report in Form 10BB. If any of these conditions is not met, then the auditor has to give audit report in Form 10B. So therefore, when I am dealing with clauses of 10B, automatically those clauses of 10BB are covered because there are no additional clauses in 10BB. All the clauses of 10B are there. Secondly, this form of 10B is to be submitted by an auditor for a trust which is availing benefits of 11 and 12, which is a charitable trust, plus the institutions whose income is exempt under 1023C, different sections as Institute of National Importance. Oh, sorry. Yeah. As Institute of National Importance or any educational institutions or a medical institutions which are defined in 1023C 4, 5, 6, 6A, etc. So whenever, for the sake of simplicity, whenever I would refer to the word trust, it would automatically include all 1023C institutions, so that I am not duplicating by saying a trust or 1023C. If now you look at the clauses which are there in 10B form, to my mind the clauses are the information which is required is more than what would be required under 3CD, because under form 3CD typically the auditor is required to give details about the expenditure which a company has incurred and what is allowable, not allowable, etc. But if you look at form 10BB, there are series of clauses which require the auditor to give details about the receipts of the trust, whether the receipts are in form of corpus, whether the receipts are by way of borrowing, and how the donations received, whether they are correctly shown under 10BD. So in short, the auditor is required to comment on the receipts as well as on expenditure, as against or in contrast with 3CD, where the auditor is only commenting on expenditure. So therefore, scope of 10B is, I think, wider than the information which is required under 3CD form. Now, there are many clauses in 10B. So what thought is that I am taking few clauses of 10B in the presentation which are important or which need some discussion. Thereafter, there are other important clauses of 10B which the panel is going to consider while giving their views on those, and then in the question answers. So therefore, to avoid any overlapping, the sections which they are going to cover in their panel discussion, I have not considered in the presentation. So you can get views on all of those sections. Now, having said that, let's go to, okay. Now we start from clause 11 and clause 12 of form 10B. Now this clause requires the auditor to give information about the objects of the trust and if there are any modification carried out in the objects of the trust. Now in this, if you look at the form and the utility which has now been recently got out by the tax department, all the objects which a trust has to be listed. So a trust may be pursuing one or two clauses, but if in its trust deed there are many other objects also, then all the objects are to be listed in 10B. There is a drop down in the utility and each object has been given a code or a serial number. So the object, if you look at the object of having religious object is code 1, relief of poor is code 2. So depending upon whatever are the objects as per the trust deed, the trust has to select all the codes and give details about all. Thereafter the form asks whether there has been any modification carried out in the objects of the trust since inception. So now the question here is, while reporting, and if there is any modification carried out, whether any application is made for registration informing about that modification, because whenever there is any modification in the object, the trustees have to apply to the income tax informing them about the modification. So here the clause, if you read, the clause says that whether the auditee, being a trust or institution, has adopted or undertaken modification of the objects which do not conform to the conditions of registration. So registration is the initial registration which has been given to the trust. So the way the form is asking is whether there are any modification to the object gives an impression that the auditor has to report whether there is any modification in the object since the formation of the trust, and not only during the year, because otherwise the section or the clause would have been worded little differently. There is no guidance on this which is given whether you have to, or there is no drop down which says that you have to fill only the date which falls within the current year, etc. So it is also an open field which allows you to put any date, and therefore the impression is that if there is any change since the inception or registration of the trust, details of that have to be given, that yes, there is modification, then there is application made for registration within 30 days, and the registration, whether it's granted or it's pending, or what is the status of that registration. Now the another question which is required to be answered is that if one is taken a view that yes, there is any modification which has happened in the objects of the trust, then what could be the date that when we consider to say that yes, this is the date where modification has happened, and then within 30 days an application for registration has been made. Now there are various possibilities. One could be the date where the trustees have decided or passed a resolution to modify the objects. The second date possibly could be where the application is made to a charity commissioner to say that the objects of the trust are amended. Third is the date by which an application is, when the approval is given by charity commissioner to the modifications made. And the fourth and the last date could be the date when the application itself is made to income tax to say that this is the date. Now if you look at all these options which can be considered as date, in my view, it should be the date when the trustees have passed their resolution to say that there is a modification, because the events which are done afterwards, that is the application is made to the charity commissioner has given approval or application is made, these are the events which flow from the initial date where trustees have decided that modification has to be made, and that is the date for modification, and within 30 days of that an application has to be made for change in the object clause. Clause 13 is the clause which contains information about the commencement of activities of the trust. Whether the activities have commenced during the year, there is a categoric question, and when the activities have commenced during the year, there is a provision which says that the application, the initial application which could have been made by the trust is for provisional registration when a trust is set up. But when the activities actually start, then the trust has to apply for a final registration from the provisional registration within 6 months prior to the date of expiry of the provisional registration, or within 6 months of commencement of activities, whichever is earlier. And that's why it becomes important to understand or ascertain what is the date when the activities have commenced. Again, there are various possibilities. Can it be the date when the first donation is received by the trust? Can it be the date when first application is made by the trust? Can it be the date where trust has hired its employees who are actually going to do the activities? So again, there are various possibilities. If you look at into the overall scheme by which the trust is going to do its pursue its objects, or going to do the application on objects, it is when the trust starts with the first of its activity, that okay, there is a meeting held by trustees have decided that okay, we are going to start or initiate a particular project in pursuance of the objects, and we are now going to commence the activities of the trust. That could be the date where the activities of the trust are commenced. It need not be the date when actually the trust goes and spends the first rupee of its object, or it need not be the date when actually the trust receives its first donation. It has to be the date when the trust has taken first step towards the activities or towards the objects for which the trust is set up, and that is the date on which the activities can set to be commenced. Oh yeah. Now clause 14. Now clause 14 requires the auditor to give information about the books of accounts and other documents, whether such documents and books are maintained by the trust. Now rule 17AA gives a long list of documents and the books of accounts which a trust is required to maintain. This rule 17AA was the new rule 17AA was introduced by 10th August 22, and this, if you look at the rule, it gives you starting from the basic books of accounts like cash book, ledger, journal, serially numbered bills, serially numbered receipts, and so on, and so many other documents. The rule further says that these documents and the books have to be maintained at the registered office of the trust. The trust is free to maintain books at any other place of its choice, but if that is so, then trustees have to pass a resolution saying that the books will be maintained at other place, and within 7 days of passing the resolution, an intimation has to be given to the assessing officer informing him about the place at which the books of accounts are going to be maintained. Now many a times we find that the books of accounts, the trust may have a registered office as the address of one of the trustees. The actual books of accounts are maintained on field where the trust is actually doing its activities, or books of accounts are maintained at the accountant's place who is operating from his house. All these possibilities exist considering that the trust may not have an official registered office. So now the auditor is required to comment in Form 10B that a pointed question of yes or no whether the books of accounts are maintained as per 17AA, whether they are maintained at registered office, whether a resolution is passed, and whether the officer is informed. And why this condition of maintaining books of accounts and documents as per 17AA becomes critical, because if you see section 12A, section 12A says that this is the condition which goes to the root. If this is not met, the benefit of section 11 and 12 will not be available to a trust. So therefore this condition or rule 17AA becomes very, very important, directly affecting the benefit of section 11 or 12. And therefore now when the auditor comes across a situation where the trust has maintained books of accounts which gives all the information which is required, but it may not technically fall in A, B, C, D requirements which rule 17AA has given, or the documents are in possession of the trust, probably they are not in a way organized as 17AA requires. So in such case, whether the auditor would qualify by saying that yes, it is not maintained, taking a very, very, very narrow view of the matter, which will affect the trust by not getting the benefit of 11 or 12, or the auditor has to take an overall view of the matter to say that yes, the substance of the provision is met, whereby all the information which is required by all the documents and books listed in 17AA is available for me as an auditor, and therefore in substance the compliance of 17AA, rule 17AA are done. To my mind, the second view is a possible and a better view of the matter, because the requirement of 17AA is finally to to give all the information to the trustee, auditor and the assessing officer. All the information is available. The information may not be in particular format, but the substance over form will prevail, and the auditor can take a view that yes, all the books are maintained. Take a second case where the books of accounts are not maintained at the registered office and the trustee is not being aware of, have not passed a resolution, or after passing resolution have not informed the assessing officer. So technically again the conditions of 17AA are not met. In that case, probably the auditor can inform the trust that okay, if you have not passed resolution, pass the resolution today before the audit is completed so that an adverse remark can be avoided. If you have not informed the assessing officer, may it be a delay, but file a letter today informing that this resolution was passed. So all these steps can be taken by the auditor to mitigate the hardship which will be caused to the trust, and at the same time to safeguard himself when he is reporting. Of course, the auditor is free to put this in an observation that it was not done within 7 days of maintaining the books at a different place, but the trust has in substance complied with it by filing a letter at a later date, and so on. So these observations can be helpful so that the trust is saved of the mishap of not getting benefit of 11 or 12. To my mind, the most subjective clause of Form 10B, clause 15 to 18 are about the activities of the trust and whether the trust is carrying on any activity in the nature of business, trade, commerce, or providing any service in connection with business, trade, commerce. Now here, this clause was never there in earlier 10B, and it was left open for the assessing officer to decide whether the trust is carrying on any business activity, and therefore proviso of 215 applies. Now in new Form 10B, an auditor has to specifically comment on whether the trust is carrying on any business activity. Now as you all know, whether a trust is carrying on any business activity or not is such an subjective question related to facts of each case as to what is the activity, whether the activity is actually connected to the advancement of the objects of the trust. If yes, then what is whether the activity is giving any surplus. Now with the new Supreme Court decisions, whether the surplus is adequate or is excess or it's fair. So when the auditor is to comment on this pointed question of whether proviso to 215 applies, the auditor will have to consider all these events, not only the provisions of the Act, but the facts of each case in the event when there is a surplus, the surplus is arising out of what activities, whether the surplus is reasonable, etc. before he comments, because if he comments yes here, the trust is for sure going to lose its exemption under 11 and 12. So therefore, if the trust is actually carrying on certain activities which is giving trust any receipts, that the auditor can put his observations. If he believes that this is not a business activity, auditor can put his observations in the notes, the view taken by him and the view of the trustees based on the representation which he may take from trustees, whatever deems fit, and such disclosure can help him to answer the question here whether the trust is carrying on any business activity or not. And if the question is answered yes, that there is a business activity carried on, then the subsequent questions follow, that what is the amount of receipts from this activity, what is the percentage of receipt of your business receipt vis-a-vis the total receipts, because the proviso to 215 allows 20% of the receipts can be from your commercial activity. So all this, the now tax department is seeking the auditor to certify to make their job easy, to take this information and do assessment for the trust. Again, if there is any business activity, admittedly, then whether the business which is carried on is for advancement or attainment of the objects of the trust, if yes, then whether separate books of accounts are maintained. Now, what really you would mean by separate books of account? Do you actually expect the trust to maintain a separate cash book, ledger, bank book? Or when the accounts are maintained in an electronic format, whether the code given to certain activities which are genuinely business activity, so you can give that code and a separate P&L or trial balance is drawn out of that and ready available to you. So whether that would meet the requirement of separate books of accounts maintained by that business undertaking, for which you say that it is a business activity. To my mind, as long as a separate trial balance, profit and loss balance sheet can be drawn out of the electronically maintained books of accounts, the requirement of separate books of accounts would meet, not necessary to maintain actually a separate cash book ledger for such activity. Clause 19. Now, if you look at this clause is about the TDS deducted by payers when they are making payments to the trust. And the clause says that where there is a TDS deducted under section 194C, 194J, 194H and 194Q by the payer, the trust has to give information in the format which is given by the form, which is the name of the deductor, PAN of the deductor, the amount paid, what is the nature of activity from which the TDS is deducted, etc. Now, if you would try to correlate the disclosure which is required under this clause and the earlier clauses where the auditor is reporting about whether there is any business activity, you can see that these are the sections where typically TDS is deducted, where the payer is making payment for certain business activities or services in the nature of business, contract, professional service, royalty, commission or sale of goods. So the very fact that if the trust has received receipts for which the payer has deducted tax under these sections, this would give some kind of indication that the activity which trust is carrying on is in the nature of business, or that is perceived to be in nature of business, so that the payer is deducting tax in this case. And therefore, when a reporting is made under this clause, again the information is easily available to the tax officer to question that why would there be TDS under this section by the payer if the trust is not carrying on any business activity. Now, when there is a deduction, reporting will have to be done here, but of course the auditor will also reconcile the amount of TDS with annual information return to see whether it has been correctly, because sometimes by mentioning a wrong PAN, the payer has put information in your AIS which may not actually be the TDS relating to the activities of the trust. So in that case, it is advisable for the trust to file remarks against the AIS, TIS, get it amended so that the TDS is removed, or he at least says that the transaction does not belong to me, so that the auditor can report, not report such payment in this clause. Okay, now next set of clauses, clauses 20 to 27 are the clauses which talk about the voluntary contribution which is received by the trust and the form 10BD which must have been filed by the trust. Now 10BD reports all of the donations which it has received and the name, address of the donor, etc., based on which the donor gets ATG in its return. Now this these set of clauses typically require a trust to reconcile the reporting in 10BD with the total receipts which the trust, or total donations received which the trust is showing in its audit, which is showing in its accounts. Now this is the amounts which are reported in 10BD. Then there are some amounts which are not reported or which are not required to be reported in 10BD. That means if there is a religious trust and there is a donation received for temple, mosque, etc., then that amount is not reported, not required to be reported in 10BD, and that's why it will not be reported in 10BD. The clause further says that where there are donations received in excess of 2000 in cash, now that donation amount also gets reported in this clause under the heading which are not required to be reported in 10BD. So 10BD, if you look at, does not tell you that if you have received donation more than 2000 in cash, do not report in 10BD. But when you read 10BD in conjunction with this clause, it gives an indication that the amounts which are not required to be reported in 10BD, in which this amount is put, that cash donations received in excess of 2000. So therefore cash donations in excess of 2000 may not be reported in 10BD because that donation is not eligible to for ATG, and that's why you are not going to be reporting 10BD, but that amount will be shown here because this is reconciliation of the total receipts of the trust. Similarly, there are donations which are not shown in 10BD because you do not have, you have the name and address of the person, you do not have PAN or Aadhaar of that person, and therefore when you go to fill form 10BD, these amounts cannot be reported in 10BD. Now those amounts are to be shown here that they were not reported in 10BD because of no non-availability of any identification. Now this clause can be, the reporting here can be different from the anonymous donations taxable under 115 BBC, because under 115 BBC the donations which are called as anonymous donations are the donations for which the trust have no record to identify the donor. So the trust does not have name, address, nothing of the donor, as against the amounts reported above where you have name, address, but you do not have PAN or Aadhaar, which happens in many cases. Some donor just walks in and gives you a donation, he gives his name, address, but he does not give any further detail. So here the only danger which I see is that if any amount is reported under bullet 3, that it is not due to non-availability of identification, the tax department may treat it, or the CPC while processing may treat it as anonymous donation, but that needs to be fought out separately because it is clearly not an anonymous donation, and the clause also distinguishes between the two donations received. Further, the other donations which are foreign donations, of course they are not, if they are not shown in 10BD, will be shown here. The auditor has to take care to reconcile this with the FCRA returns and the foreign bank account and the bank account where foreign donations are deposited, and the corpus donations. The corpus donations received by the trust are not eligible for ATG to the donor, and therefore they are not shown in 10BD, but they will be shown here because the total receipts are to be reconciled. The auditor of course will verify the direction letter from the donors to ascertain that it's a corpus donation or it's not a corpus donation, and by doing this the final total amount will be the total receipts which the trust has received during the year. I directly go to clause 31 because this is the clause which requires the auditor to give details of application which the trust has done during the year. Now there are many sub clauses in this clause. So 37(1) is about the income which is applied within India. Now in this, the application for each object has to be shown separately. There is a table in form 10B if you see. Application on religious, application on relief to poor, application of education and so on. And the last 10 residuary is that application which cannot be specifically categorized under 1 to 8 above. So now in this clause, whatever are the application made to each object will be shown against that, but there could be the administrative expenses or the expense on running the trust which is or cannot be related to any specific object. It is the general expenditure of the trust, and that general expenditure will have to be reported under this clause as application which cannot be specifically categorized, because there is no other place in the form to show the administrative or the day-to-day running expenditure of the trust. And the total of clause 31 is the application which trust is doing. So if you do not put here, there is no other place to take that as a deduction. So it will have to be shown under this clause. Then clause 31(2) says that if there is any application of income in excess of 50 lakh, then the other details are to be given like name, address, PAN, etc. Again, the clause if you see is worded as details of application resulting in payment in excess of 50 lakhs during the previous year to any person. So therefore, whether it is 50 lakh individual or 50 lakh in aggregate during the year to a particular person, on reading the clause and the intention behind asking this information, to my mind the information here is to be given if the aggregate payment to a person is in excess of 50 lakh during the year. Clause 31(3) says that the amount which is not actually paid is to be shown under this clause. Now this will be relevant for the trust which follow mercantile system of accounting or section 8 companies which are mandatorily required to maintain these books of accounts on mercantile system. Now in these two cases there would be a case where provision for expenses is made because you are maintaining books on mercantile system of accounting. Now Income Tax Act, the amendment which has come in says that the expenditure will be allowed only if it is actually paid. So all the provisions which are made for expenses, which typically could be your expenses of March month or any amount of provision, which is going to be added back while computing the application. If there is similarly a provision which was made last year which was disallowed or added back, then during the year the amount would be paid, and therefore there would be a separate allowability of that item which the trust has to consider. Now the provisions, the similar provisions we also see in 43B, but 43B gives you a specific extension of time till the due date of filing of the return to claim that amount as allowable. But that kind of provision is not there in section 11 and 12, and therefore even if the provision is paid off immediately on 5th or 6th of April, while calculating application for 31st March, the amount is not going to be allowed. 31(6) requires to give bifurcation into revenue and capital expense, because as you know the capital expenditure incurred also can be claimed as application in year 1. So therefore a bifurcation is required. Clause 31(7) is about if there is an amount spent out of corpus in earlier years, and because it is spent out of corpus you don't get a deduction as application done. But if the amount is replenished or put back in corpus or invested in the prescribed modes, then the year in which the amount is replenished, a deduction is allowed to the trust as application, subject to the replenishment being done within 5 years. So if such event has happened, the reporting will be given in clause 7 and clause 8, similar provision where there is an expenditure made out of borrowing and the borrowing is now repaid within 5 years, the deduction will be allowed or it will be treated as application in the year in which repayment is done. So the auditor has to closely look at the expenditure incurred, where there was any amount spent out of corpus, or where there is any borrowing in the trust, to report the amount correctly. I know it's a difficult task, but a reporting is required under these two clauses. Then there are clauses which with a heading amount to be disallowed. Now where there is a payment made without deduction of tax, the provisions of 40A1A apply in the same manner to the trust. So 30% of amount will be disallowed. The year in which you pay the trust pays the TDS, the amount will be allowed, because the provision of 40A1A will apply as it is to the trust. Similarly, 40A3 payment in excess of 10,000 disallowed will be reported here. Now only one situation, that when there is a TDS paid in any subsequent year and the trust wants to take that amount as application, there is no clause for the auditor to certify that the TDS has been paid and therefore now the trust can take it as allowable. But I understand that the situation is same in Form 3CD also. There also there is no requirement required where TDS is now paid of past amounts which is disallowed. And therefore when trust is now going to claim those amounts as allowable, there will be no disclosure in 10B, resulting in some mismatch by CPC, because we have seen such kind of proposed adjustments notice in 3CD as well, where there is an amount claimed as allowable under 40A1A now saying that TDS is paid, but because there is no disclosure and tax audit, the allowability is amount is not treated as allowable by CPC. So same challenge can be faced even in 10B. 3111, donation to other trust towards corpus. If any donation is given to other trust towards that its corpus, the amount is not allowed as a deduction. So again the auditor will have to verify the direction letters which are issued to justify whether the donation is to the corpus or it's a general purpose donation. Now there is a clause which requires an auditor to say that when donation is given to other trusts which do not have same objects, then what happens? Now there could be a situation where the trust to whom the donation is being made has 4 objects. One of the object is the object for which the donor trust is engaged into. So a donor trust has an educational object, the donee trust has education and medical object. So it does not have identical objects as that of the donor trust. In this case, when the donation is made to the donee, now such amount ordinarily has to be considered as application, because it is for the same object which the donor trust is pursuing. But in that case, it is advisable that the trust, while giving the donation or forwarding the donation check, should clearly mention in their letter that we are giving this donation, we request you, or the donation is towards the educational objects carried out by the trust, because based on that the reporting in this clause then can be avoided. Because if the reporting is done in this clause, the heading itself in the form is amount to be disallowed. So therefore the amount will automatically get disallowed. Then of course application outside India, which is as per the Act, it's not allowed unless certain conditions are fulfilled. An application for any purpose other than objects of the trust, of course it's not going to be allowed. So after doing, there are a few more clauses. Clause 19 and clause 20 is about the option which a trust has exercised, because it has not spent 85% in the current year. So it exercises the option to spend the amount in the subsequent year by filing Form 9A, or the trust accumulates the amount for 5 years to spend on specific object by filing Form 10. So the trust is required to file Form 9 and Form 9A and Form 10 by the trust were required to file before 31st August. So where reporting is done here, the auditor will naturally verify clause 9, Form 9A, Form 10, whether the trust has been filed before the due date. Now there is a circular which is issued by CBDT, Circular 6 of 23, dated 24th May 23. Now this circular contained various points. One of the point was there was a general extension given to the trusts to apply for provisional or to final registration who had missed their deadline of September 22, which was given for making the registration. One of the point in that circular is that if Form 9A and Form 10 is not filed before 10th August, but if it is filed before the due date of filing the return, then the option or the accumulation cannot be denied to the trust. That is what the circular says. So if the trust has missed out these deadlines, reliance can be placed on this circular to take the benefit of extended time. For filing Form 10, there has to be a resolution. Specific auditor has to even verify that resolution. Now after doing all this exercises of amount allowed, disallowed, etc., then the net figure which will be shown in the form will be treated as application of the trust for the year for calculating the computation. So you have your gross receipts calculated in the earlier clause, you get the total application by following all the reporting in clause 31, and therefore then you have the figures of gross income and gross the application. Now clause 37 is the clause which requires the auditor to report when there is an application made out of certain specific sources. Now there has been option exercised in earlier year, there has been an accumulation done by the trust in earlier year, or you have your general standard deduction of 15% of earlier year. So in the current year where application, now you have determined what is the application made, because in the clause 31 you will get your total application. Now in that case, in this clause, the auditor has to go a step further and identify whether the application is made out of the option which was exercised last year, or it is out of the 5 years accumulation. It is easier to report if it is out of 5 years accumulation. I can understand, because it is accumulated for a specific purpose, and if you can correlate the purpose, one can report here. But the difficulty could arise when you are reporting under clause point C, that you are spending out of the general standard deduction of 15% which you had, or you are spending out of the option which you had exercised in the last year to spend the amount in the subsequent year, because here the option or your standard deduction is used for the general objects of the trust. There is no specific purpose, etc. So in that case, it's going to be very difficult for the auditor to say and pointedly say that it is out of this. It's not possible to correlate. And therefore, one could use the FIFO basis that yes, whatever is the application done is spent out of the option exercised in the last year, so that the option gets fully utilized, because if the option is not utilized, it will be taxed under 115 BBI, which the panel will consider. So therefore, one has to exhaust the application, the option which is exercised in the last year first. And therefore, out of anything spent in the current year, the auditor should first report again under clause B that option is exercised in the earlier year and the amount is spent in this year. Then the reporting, if there is any amount spent out of corpus, so if the expenditure is more than what the funds available with the trust are, then that means the trust is spending out of its corpus. Or if there is any application made out of the borrowings, then that also needs to be reported here. Now one point I missed out while mentioning, when you are talking about your gross receipts, or when you are talking about when you are talking about the application made by the trust, in many times I find that in the accounting of the trust, there are amounts which are directly credited to earmark funds where grants or donations are received. without routing it through the income expenditure account. And similarly, any expenditure which is incurred from that grant or the earmark project is many a times directly debited in the balance sheet to that project and not routed again to profit and loss account. So all such amounts need to be ascertained and put in the relevant schedule of gross receipts and application, though they are not routed through P&L, because unless you do that, your gross receipts and your application would not show a correct figure. So that care the auditor has to take. I'm not getting into this related party transactions because clause the transactions with specified person was there in old form 10B also. The transactions are listed in 13.2 and the challenge for the auditor is that he has to identify and then comment on the adequacy, which of course it was there in old form 10B, so I am not getting into that. 44
Recording stopped.
44,
Recording in progress.
Clause 44 says that where there is depreciation claimed on the asset which was claimed as fully as application in the year of acquisition, the reporting has to be done here. So the auditor has to verify the computations and not the income expenditure, because income expenditure could show depreciation year by year, but the application could have been considered in year 1 when the asset was acquired. So after reviewing that, the reporting can be done in this clause. Schedule corpus, in which the corpus donations received prior to 1/4/21 and after 1/4/21 have to be shown separately because of the amendment made in the Act, which requires that after 1/4/21 the corpus received will be intact, it will be invested in prescribed modes and so on, and therefore the reporting is separate. TDS disallowance schedule similar to 3CD, any payments made whether the TDS deducted or not. Schedule TDS shows that whether the TDS returns are filed, interest is paid, whether delay in filing TDS returns, etc. One point which actually I should have considered at the beginning, which I am considering it now, is who can issue Form 10B or Form 10BB. The trusts are basically governed by the Maharashtra Public Trust Act, and there is an audit prescribed under Maharashtra Public Trust Act. It has a specific format in which the accounts are to be maintained. Now, can there be a situation where under the Mumbai Public Trust Act, the auditor is a different auditor than the auditor who is issuing Form 10B? Can that situation happen, or can that situation work? Now, if you look at the wording of section 12A, which says that, which prescribes for Form 10B, the section 12A is saying that the accounts have to be audited by an accountant mentioned under section 288, and the report of the audit by such accountant has to be issued, which gives an impression that the audit report has to be issued by the auditor who is auditing the accounts. Now, auditing the accounts, whether it means the auditor who is actually signing the accounts, or can it be the auditor who can rely on the audit done by the auditor under Mumbai Public Trust Act and say that I am relying on the audit done and then only issue an audit report? Looks a little difficult to argue on this, and again difficult for a trust to have an audit under a separate audit under a Maharashtra Public Trust Act and have audit under for 10B a separate. So therefore, ideally there should be one auditor who will audit the account under Maharashtra Public Trust Act, audit for 10B and comment on it. The Maharashtra Public Trust Act would prescribes a specific format for income expenditure and audit. Income Tax Act does not prescribe a format. So the audit which is conducted in the prescribed format reported for Maharashtra Public Trust can work for 10B also. So for this purpose you don't need a separate auditor. So ideally the situation can be the accounts are prepared in the format of Maharashtra Public Trust. the auditor who audits those accounts also issues Form 10B, because while issuing Form 10B, if you look at the wording of 10B, in the Form 10B, it says that the auditor is certifying that the particulars which are given in the annexure of all these clauses are true and correct. So when an auditor has this onerous responsibility of commenting that all the details which are given here are true and correct, he may not be comfortable in considering or relying on the audit which is done by a different auditor. He will virtually again get into verifying all the accounts, documents, etc. to report here. So therefore, he will conduct a separate audit. So to avoid duplicacy, there could be one auditor under Maharashtra Public Trust and for income tax and issue a 10B form. Now all this information, again very difficult for an auditor on his own to report, to dig into the records of the trust, especially when the trust do not have sufficient, adequate, qualified manpower. The trustees who should be in a position to give a representation for certain clauses which the auditor is not in a position to verify. Relying on those representations, reporting can be done here. All this auditor will of course have to record in the observations which he will do, and if you look at the utility on the income tax, it's same like TDS 3CD. It allows you to upload the utility along with profit and loss balance sheet if there is business and there is any other documents. So in that any other document tab, these observations, howsoever lengthy they may be, can scan copy of that can be uploaded so that the auditor is safe while reporting these transactions in this clause. I think I have exceeded my time, but thank you all.
Good morning, everyone. With trust in our hearts and to the trust that we trust, auditors will have to be excessively vigilant and raise the bar of professional skepticism, as Sonali explained us. Sonali, you have simplified this hyper-complex IT form, which will become a great reference to all the participants here today. On behalf of team IMC, BCS and CTC and everyone present virtually and physically, we send you a round loud applause. Thank you very much, and it was great listening to you. We shall now break for a tea for around 10 minutes and shall resume at 11:20.
I just have one comment. While this is meant for us to educate us as to what new compliances are there so we are fully compliant, whether at some point we can also come to some conclusions on what we must advocate for. So whether, what are the objects of each of these changes, and if we as a chambers are meant to represent to the government that, this is all meant to further the objects of the country, and also make sure that, the objects are used for the benefit of the charitable purpose. So if there are things that can be simplified, what should be simplified? We can also do an advocacy cause, which I think is also important for us.
My mind is to get the information on platter, which till today was not available to the tax department. So therefore simplification certainly is needed for a charitable organization which is reducing the burden on government machinery. With this, I feel there would be many trusts who will not be in position to take this burden and probably will curtail their activities. So it's going to be a loss to the community. Yeah.
So we reconvene in 10 minutes. It's 11:20. So 11:30, shall we say? 11:30 we reconvene to those who are online also.
Recording stopped.
everyone for the second session on issues and complexity relating to the revised audit form. I think for this we are very privileged as all the associations to have CA Gautam sir and Anil sir to enlighten and enrich us on the given form issues and complexities of the form. I think we'll just start with their brief introduction. CA Gautam Nayak sir, he's a practicing chartered accountant since 1986. He's a partner of the firm C&K and Associates LLP. He's been the past president of Bombay Chartered Accountants, and he's been associated with various committees of Bombay Chartered Accountants and IMC. He's a very regular speaker at all the forums at WRC, BCS, chambers. And he's a regular contributor to various articles and publications. He's been a co-author of 4 editions of Transactions in Shares and Securities, Taxation and Accounting published by BCS. He's been editor of the Taxation of Charitable Trust, which is being published by BCS. With this, CA Anil Sate sir, he's a chartered accountant and he's practicing since the year 1982. He's a past president of Bombay Chartered Accountants Society and been a former editor of BCS Journal and currently the co-chairman of the Taxation Committee. He's a very, we all know that he's again a very regular speaker at all the various forums and has been authoring various articles at the various forums. I think with this, not wasting much time, sir, the dais is all yours. Thank you.
Thank you for the kind words of introduction. I'd like to just supplement a few things, which before we start on the specific question, because I think, for instance, this question has been dealt with to some extent by Sonali, and just a question. See, what you have to remember is that the audit report is what the auditor is giving, and he's giving 2 things. One is he's giving an opinion on the true and fair. The second is he's giving a certification of the true and correct view of the particulars which are next. Now, just like as in the tax audit report, the preparation of those particulars is the responsibility of the trust here, is the point that we should insist upon. Get those particulars certified by the trust, so far as we are concerned, so far as the working papers of the auditor are concerned. So it's the trust's responsibility to compile those particulars. The auditor is merely expressing his view on those particulars. So that is the first thing so far as the auditor this is concerned. The second aspect of it is that it's not necessary to do 100% checking, it's impossible to do 100% checking for many of these clauses. So what you need to do is apply your test check, apply your judgment, etc. And the most important thing is there is a provision under the audit report also that for each of this, for the true and correct view as well as for the correctness of the particulars, there is a provision to give observations or qualifications. So therefore use that to give them, particularly on areas which are tricky. So particularly you've taken a view where the Supreme Court and orders whether it applies to whether it's a business or not, or whether you're taking a different view, whether you're taking, because say because it doesn't fall under general public utility, therefore it's possible to take a different view. So things like that, or where certain particulars are maintained, significantly are maintained, but certain part of that is not missing, etc. So use that to give these observations. It could be said that as per annexure, as Sonal said, you can upload an annexure along with that. So that is something which is possible. But that is, I think, something which is most important, and that is the key role, I think, of an auditor, because ultimately what you need to realize is that one wrong comment can result in a total loss of exemption, it can result in cancellation of registration, and an enormous amount of litigation for the trust. So therefore, it's extremely important that you have to strike a balance in both. As an auditor, you are required to be transparent, you are required to report, but at the same time, you are required to ensure that this does not completely, hamper the trust from getting any tax exemption at all. So that is, I think, the other thing is, of course, the time limit which is given. For instance, I was just trying yesterday, there's a trust in which I am a trustee, and I said, let me just add this name of the auditor because the form reporting is ready. I can't add the name of the auditor. For 23-24, that's still not activated. So that is still not possible. Now that though the utility is available, I think that is the biggest problem which is there. And one more point, sorry, I just wanted to supplement again what Sonali mentioned. One of the points she mentioned is that corpus donations are not eligible for ATG. I think that's not the correct position. ATG, corpus donations as well as general donations, both are eligible. It's only when one trust makes a corpus donation to another trust, then that is not allowed as an application of income. So that is the position. So far as this significance of this amendment now in Section 12A is concerned, if you look at the explanatory memorandum, they said that there is no requirement to maintain books of accounts, and this is for better implementation and monitoring, is what they said. And as Sonali mentioned, it's a precondition for exemption that if we don't have not maintained the books of accounts and the documents prescribed, it can result in loss of exemption for the year. So therefore, I think it's extremely important that particularly where some part of the books are maintained and some is not maintained or is available in a different form, one needs to take a view whether the information is available or not. That is the main thing that you have to see. That it may not be in that specific format, etc. But so long as it's available, maybe you should suggest that the trust could modify the manner in which they maintain records, etc. to help from that perspective. That's the so far the first question is concerned. So the second question is again, can we go to question number 2? Yeah. So the format of the final accounts, again, Sonali touched upon it, but I'd just like to supplement here that there is one book which is available, ICI Technical Guide on Accounting for NPOs, 2022 edition. It's available online. I would suggest that all trusts just have a look at this. This is something which could come to your rescue very often, particularly on the method of accounting, etc. And there, para 109 of that book says, NPOs which are not registered under the Companies Act, but the statute which governs them is prescribed the format for the purpose of preparation of financial statement, should prepare the financial statement in accordance with the requirements of the said statute. So where you are governed by, say, the Companies Act or the Maharashtra Public Trust Act, your account will be prepared in accordance with that statute. So it's not this. There is in that technical guide, there is a recommended format for NGOs, but that would apply in states possibly where they don't have the local legislation like the Maharashtra Public Trust Act. Because today in Maharashtra, if you're a company, you follow Companies Act. If you're a society or a...
Voice is not clear, sir. Voice is not clear.
Yeah. So is this clearer now?
No, a little bit louder. A little bit louder.
No, sir, we are not able to hear. Yeah. And more echo, more resound.
So, therefore, look at it from this perspective that if you are a trust in Maharashtra or a society in Maharashtra, if you are a trust, if you are a trust or society in Maharashtra and or a company, Section 8 company or Section 25 company, if you are a company, obviously Companies Act governs you. If you are a society or a trust, you are required necessarily to be registered under the Maharashtra Public Trust Act, and therefore you would follow the Maharashtra Public Trust Act. Companies would follow the Companies Act provisions. That's Anil.
Yeah. Am I audible or same problem still? Yeah. Okay. The question is, what is the meaning of separate books of account to be maintained, and the reporting clauses are clauses 17 and 18. Prima facie, I would concur with what Sonali said, is that what ultimately do books of account do? They help you to determine the income of the entity which is being applied and tested for the exemption under Section 11. So ordinarily, if the separate books are maintained, or you are able to cull out from the record as is maintained the income pertaining to a separate business under Section 11.4 and an incidental business under Section 11.4a, ordinarily that should suffice. As far as 11.4 is concerned, normally separate books of account will always be maintained, because 11.4 talks of a business undertaking which is settled on a trust, which is the income whereof is then being utilized for the purpose of charity. So
a business undertaking ordinarily will have its own separate books of account per se. The real problem arises is when an activity is treated as a business and the law requires, in terms of the proviso to 215, to analyze as to whether it is incidental to the attainment of the objects and whether separate books of account have been maintained. So, if from the books of account you can cull out the income, the revenue and the expenditure of the incidental business, that ordinarily should suffice, that really satisfies the purpose of the provision. Having said that, I would suggest that in order to avoid litigation, as Gautam says, we are looking at a period where, unless the law is significantly amended, we are looking at a spate of litigation over the next 5 to 7 years. People like me and Gautam who practice in tax and tax litigation, would do well. But we have reached a stage in life where we do not need to earn our bread from charitable institutions. But yes, we do see a substantial litigation possibly ensuing. So I would suggest that in terms of 11.4a also, separate books are maintained. Many of the large entities maintain their books in tally, and that facilitates what is called maintaining a separate company. They call it a separate company. Rather than only relying on cost centers, rely on a separate company where the revenue streams qua the activity which is treated as a business is separately identified, the direct expenditure is identified. And why I am saying this is that already there is a ruling of the Bombay High Court in Indian Machine Tool Manufacturers Association 91taxman.com 465, which said that merely an enabling situation where you can cull out that information is not sufficient. Separate books of account maintained separately, which are the words used by the legislation, should be followed. And because books of accounts are now a condition of the exemption, I would suggest that as far as possible, maintain them separately. Next question. What address should one report under clause 14 for books of account and documents maintained on a cloud? We are obviously talking of very, very large trusts or trusts which rely on maybe a service provider to maintain their accounts on a regular basis. The cloud server could be outside India. Now let's look at what the purpose of the address in clause 14 is. The purpose is that those books of account should be accessible to the reviewing or adjudicating authority. Now therefore, if they are only maintained on cloud and are not accessible, I don't think it really meets the purpose of the law. So therefore, even if they are maintained on cloud, either a periodical backup or a daily backup, if the volume of transactions is very large, should be maintained in India at the registered office of the company ideally. But if the registered office of the company does not maintain the ancillary record, then it should be maintained at the place where that ancillary record is, and the requisite information ought to be given to the jurisdictional officer, the resolution and the intimation thereof within a period of 7 days as the law mandates. Next.
So the next question relates to this cash method of accounting. So as you know, under cash system of accounting, the assets, liabilities, income, expenditure, all is on a cash basis, when it is on an actual payment basis. The question is, does that show a true and fair view of the accounts? Can one say that is any qualification required or any disclosure required. And here again, if one looks at the ICI Technical Guide on Accounting for NPOs, in paragraph 32, it says accrual is the scientific basis of accounting and has conceptual superiority over cash basis of accounting. It is therefore recommended that all NPOs, including non-corporate NPOs, should maintain their books of accounts on accrual basis. It's only a recommendation, it is not a mandatory requirement, firstly. Secondly, also if you look at the guidance note on tax audit which the institute has, of course the institute was supposed to come out with a technical guide on this audit of NPOs, but I think it's still under preparation and it's not yet out. But so in the guidance note on tax audit in para 10.18, which deals with financial statement prepared on a basis other than accrual, it says, in case where the statute governing the enterprise requires the preparation and presentation of financial statements on accrual basis, but the financial statements have not been so prepared, the auditor should qualify his report. So therefore, say for instance, if you have a section 8 company or a section 25 company, it is mandatorily required to follow the Companies Act, which requires accrual. So therefore, there in that situation, if they don't follow accrual, the auditor has to qualify his report. Then it goes on to say, on the other hand, where there is no statutory requirement for preparation and presentation of financial statements on accrual basis, and the financial statements have been prepared on a basis other than accrual, the auditor should describe in his audit report the basis of accounting followed without necessarily making it a subject matter of a qualification. And in such a case, auditor should examine whether those provisions of accounting standards which are applicable in the context of basis of accounting followed by the enterprise have been complied with or not, and consider making suitable qualification accordingly. So what is the institute saying? That yes, if you follow cash basis of accounting, the auditor should mention in his audit report saying that these accounts have been prepared under the cash basis of accounting. I think that's all, that it's a disclosure which is required, and that is therefore something which is, it's not a qualification, but it's a disclosure which is required. So that is something which I think auditors need to keep in mind so far as cash system of accounting is concerned. Next question. This is a practical difficulty now in case of a society having thousands of members. How is it possible to now see, if you see the reporting requirement, it talks about details of all authors, founders, settlers, trustees, members of society, members of the governing council, directors, shareholders holding 5% or more of shareholding, office bearers of the auditee. So I can understand members of governing council, trustees, settler, founders, you can easily list those, that is not a problem. But when you say members of society, now, I was just talking to one of the central council members of the institute, and I said, how are you going to report that you have got 250,000 members? How are you going to report that? So he says, it's not impossible. Or you have many societies which have tens of thousands of members, so, or thousands of members also, it's impossible to report. So there I would suggest that in such a situation, one could report the office bearers, the governing body members, etc., all that could report it. And with a note that this organization has so many members, you will have to then put it as part of your observations into the audit report, saying that since it has so many members, it is not possible to list all those. While the list is maintained by the organization, it is not possible to list it in the audit report. That's the, I think, practical way in which you will have to deal with this.
So only mercantile for all the rest of the things, but only the unpaid, the provisions of year-end provisions.
So let me just, one you have to remember is that the income of the trust is normally would fall under income from other sources. That's one aspect of it. Section 145 says you have to follow either cash or mercantile system. 145.1 says that. So therefore, following hybrid is not what I would recommend. Is something, because particularly if you lose the exemption, then possibly best judgment assessment may follow, etc. So therefore, it's something which because though of course you have to calculate your computation of exemption is a separate before you come to the computation under the heads of income. Still, I think it's a highly risky proposition. Particularly if certain part of the income loses exemption, then whether that could lead to a best judgment assessment is a question.
The ideal way is to follow mercantile system and deal with the specific things in the company.
Yeah, where you're mandated. You can, if you are not covered under any law mandated to follow mercantile, say you're not a company, then you should think whether you want to switch over to the cash system of accounting completely. Is something which you should consider.
Thank you.
We'll take question answers at the end. We have kept 20-25 minutes at the end, so please.
Yeah.
So let's get over the quota first, because today is, the limited over match between India and Pakistan at 3 p.m. So we hope to conclude well before that. Now the next question is an important question. Sonali dealt with it briefly. I think the reporting under this clause has to be looked at. Yes? Not? Okay. So has to be looked at holistically. The question is whether the changes to the objects since inception have to be reported, or the changes during the year have to be reported, or the changes at a particular point of time have to be reported. Just very briefly, the legal position. Earlier in point of time, the registration was obtained on the basis of a memorandum or a trust deed which you filed, and on the basis of that you obtained registration. The application for registration did contain an undertaking that any change in objects you would forthwith intimate to the registering authority. But there was no precise form for that purpose, nor did the law mandate a separate application for registration should a change in objects ensue. That came in for the first time from 1st April 2018. So I would take a view that all changes anterior thereto certainly need not be reported. What needs to be reported is ideally changes in the year, or if you take a more conservative view, changes of an event after 1st April 2018. Now the next question is to what are the degree of changes, or what are the changes that require to be reported. The law clearly says that the objects are changed which do not conform to the earlier registration. In my view, changes which are in the nature of powers or regulations do not constitute a change which come under this particular clause. For example, there is an amendment to say that the powers of the secretary of the trust have been amended in this manner. That's a change to the regulations, not a change in objects. Further, a change in objects which is merely semantic but does not change the objects significantly. For example, in an educational trust, when it was started in 1950, computer education or maybe distance learning was not contemplated. If the trust amends its objects to include that activity, I would certainly not take a view that that is an amendment to does not conform to the conditions of the original registration. As far as the auditor is concerned, I would suggest that if there are changes which the auditee takes a view that they are not changes which require an application under section 12A1AB, then in that view the auditor should draw attention of the in the audit report saying that the auditee has taken his view. If of course the auditor takes a view that no, an application ought to have been made, then of course a clear-cut reporting in that regard would be essential.
Anil, sorry, just one point on this. Can one not take a view that one is reporting for the year, and therefore if at all one has to report, it is any changes which have taken place during the year and the application made during the year is what is required?
I appreciate. So ideally that should be the situation, but certainly not since inception, because that would be virtually an impossibility. And ordinarily your primary duty is to report on financial statements and the particulars emanating therefrom. So if that is the case, I do concur with Gautam that that would be the view. But then I would suggest that in such a scenario, you please draw attention to that aspect in your auditor's report. Yes, next. 14, 15. So these clauses require virtually reporting in a scenario where the auditee trust carries on an activity which could be interpreted as partaking the character of business activity. The question that is being put to me is whether, if you don't run a separate institution, can you say that you would get out of reporting? I would think not. My thought in this is that if you are carrying on an activity with a reasonable degree of regularity, though not necessarily designated as a project, a reporting in terms of this clause, once you fall within the residuary clause of section 215, saying that your activities constitute any advancement of general public utility, then if an activity of a trust is carried out with a reasonable degree of regularity, a reporting to my mind in this clause is required, and that activity looked at in totality should be treated as a project, and that should be reported in that manner. Merely saying that you don't have a separate institution, to my knowledge, may not suffice. So it will depend on facts, but that's the view that I would take.
The next question deals with clause 18, and the issue there is it asks, that whether in terms of business, we are talking about profits and gains of business now here. So to determine whether an activity is a business, as you know, in the Supreme Court, in the case of Ahmedabad Urban Development Authority, has taken a view that they said, what is incidental business? Incidental business means that activity is part of your objects and it is undertaken at a cost, substantial markup over cost, then it constitutes a business. If there is a nominal markup over cost, or if it is at cost that you are charging, then it does not constitute a business, is what the Supreme Court said. And this was, Supreme Court decision was in the context of the proviso to section 215. So it was in that context that the Supreme Court took that view. So therefore, now when they dealt with 215, the proviso to 215, they also dealt with section 11.4a, and they said that you have to look at this whole thing as an integrated thing. You have to look at 11.4a, the proviso to 215, the 20% requirement over there, etc. So therefore, I think that is the. Now, can one say that that decision is restricted only to general public utility cases, or would it apply even to cases of, say, medical relief, or cases of relief of poverty, or cases of education, or other clauses of section 250? There, I think, again, frankly speaking, I think each organization has to take a view ultimately on what I think a view is possible that the Supreme Court decision in Orda's case applies only on the facts of that case, but one may be able to, where one has a low margin, a low markup over cost, one may be able to take some sort of a support from that, saying that though the Supreme Court decision dealt with only general public utility cases, however, the test laid down, therefore, and based on the test which was laid down by the Supreme Court, the markup is not substantial, and therefore it does not constitute a business. But so that is possible, I think, to take that view. Otherwise, and therefore, if in case the markup is substantial, I think one can maybe try and say that the distinguish that Supreme Court decision from saying that that does not apply to cases of the other objects, which of the other clauses of 215. So it would not apply to medical relief, education, etc. is the other view which can be taken. And therefore, based on general principle that the profit motive is not there, it is not organized from a perspective of earning profit. It's from that perspective. So I think whatever view which one takes, now here I think this is something which is highly debatable, is something which could create, as I said, there are significant implications for a trust. But whatever view which the trust takes, ultimately I think as an auditor, one will have to mention in the observations about true and correct in that about particulars, saying that this is the view which the trust has taken, and on that basis the particulars have been reported. I think that is, the most important part of it. Yeah, Anil, want to supplement on that?
No.
The next clause is, I think 10 has been dealt with in a sense by Sonali, but just I'd like to point out here, see, interest, TDS on interest, you're not required to report. You're not required to report TDS on interest on securities, you're not required. 193, you're not required to report over here. So that is one the thing, because as Sonali mentioned, I think the whole objective is to find out whether you're potentially carrying on a business. Now, for instance, you could be having, say, a hoarding which is there and which is given on rent to advertising agencies. There may be 194I. Now, 194I is not required to be reported here. But if they've deducted in a 194C, obviously there will be a reporting here, though it may not be a business, because you might have given it on a fixed rent and still they've deducted under 194C rather than under 194I. Now, that reporting will be required here, but you'll have to point out that this is really not a business. I think that's something which one will have to be... and very often, I mean, I've seen cases where sponsorship people deduct under 194C, etc., and which there again one will have to take a view that this is not a business for this reason, and that disclosure, I think, is again an extremely important requirement in this case.
Yes, before I go to this question per se, just a small addition to what Gautam said in regard to the reference to the Supreme Court judgment. This is because we have come across these cases in the recent past. Is that the Supreme Court in its analysis does deal with certain situations where in a substantial markup they have said that that could amount to a business. The question really is that does it mean that we ignore the principle of cross-subsidization? Because there would be scenarios where an entity in an activity makes significant surpluses in certain activity programs, while in certain programs it incurs deficits, significant deficits. So do you look at the scenario of the nature of activity holistically, or do you analyze each program? Now, if the auditee takes a view that on a holistic basis it has not earned a significant margin and therefore it does not constitute or does not violate the principles of 215, an auditor may accept that proposition subject to his disclosure in the audit report. I think that is a view that one could take in regard to, because otherwise there could be significant difficulty in that regard. As far as this clause is concerned, the question is how do you report, because the return of income would not have been filed when you give your audit report. Now, Section 1310 has two conditions. One, a compliance with 12A1 subclause B and BA. Now, as far as these two conditions are concerned, obviously you would have tested them during the course of your audit. One is maintenance of account and the other is the change in the objects. So to that extent, the auditor would have carried out its process of verification. As far as the question of 13.8, which is application of the proviso to 215 is concerned, yes, the auditor would not have the benefit of the return of income. In such a scenario, I would suggest that because the question is that whether the provisions are applicable. Now, therefore, if on the basis of the computation and verification, you come to a conclusion that yes, the provisions of 215 do not apply, then the computation of income may be certified by the trustees and that will form part of your working papers, and on that basis you can definitely issue a report even though the return of income may not have necessarily been filed. Next. Yes, clause 22. Now, in all the clauses of reporting, let me give one sort of overview, is that many a time people come to us and say that how we can avoid reporting in a particular clause. No, I'm saying this because one must understand and appreciate that the object of the form and the rules under which that form is to give information. Whether the entity is capable of giving that information or collating is a separate matter altogether. But the object is to give information which will facilitate the assessment and the consequent exemption. So therefore, if the trust has already reported donations in kind or donations in cash in Form 10BD, is it necessary to report them again? To my mind, no, because ultimately what you are overall doing is you are reconciling, or the aggregate of all to put together has to reconcile with your accounts. If you have reported in one category, I don't see the purpose of reporting in another, unless there is a wrong reporting in one, in which case as an auditor you will draw attention to that particular clause. Yes.
Anil, just one point to supplement on this. Earlier there was a doubt whether in Form 10BD, whether you should give donations in kind, donations in cash exceeding 2,000, though they are not eligible for ETG. There was a doubt saying that, okay, would we have to reconcile, and would the department then issue a notice saying it does not match with your total donation as per your return, etc. So now this makes it very clear that when you are filing your Form 10BD next year, that only those which are eligible for ETG, those are the ones which will have to be reported therein and not others. I think that is one consequence of this. I think this brings it out very clearly. Yeah. The next issue is relating to foreign contributions, and this I think is a practical difficulty. Now take a situation where you have a trust like the Balaji temple at at Tirupati, for instance. Now try and imagine the situation where the auditor is now required to certify that every donation, there will be lakhs of donors. Now, how will the auditor practically say that, okay, give me the passport of, because as you know, what is the foreign contribution? It doesn't depend upon whether it is received in foreign currency or in Indian rupees. It depends upon the nationality of the donor. So if the donor is a foreign national, he may be an NRI or an OCI, etc. That doesn't matter. If he holds a foreign passport, then it is a foreign contribution. So that's so far as the individual is concerned. Of course, foreign entities one can very clearly identify. But so far as the individual is concerned, he has an Indian name, he has been an Indian citizen. You don't know when suddenly somebody who's been an Indian citizen has given up and taken up US citizenship. You don't know when that happens. So therefore, this is a practical difficulty which is there. And therefore, practically the situation, what one would do is, as an auditor, what should be the approach? One is take the FCRA return which has been filed, saying that, okay, all these have been, these are the donations, that's one. Take a representation letter from the trust saying that all the foreign contributions received have been included in that FCRA return. Auditor may, in case of foreign sounding names, etc., or certain this, they may do a test check to see that, please call for this, passport, etc. So that test check is something which, and then the auditor will, in his audit report, obviously will mention that, based on the representation, the FCRA return and the test checks done, that is the basis of the verification. I think that's the only way in which it's practically possible to do that. But I think the difficulty does arise for trusts also. Very often, you get a donation online, etc. You have to have a method of controlling. If you receive a donation online, are you an Indian citizen or not, is something which a donor would have to click. Something which you should ensure that your website has that facility. At least that declaration of the donor is there, that saying that, yes, I'm an Indian citizen. So that's something which maybe trusts need to keep this in mind. Or if not, at least have a requirement that you upload your passport or proof of citizenship, at least, something like that. Particularly when you have a large number of donations which are received online. Yeah, next question. So this question is, if you look at this clause 31, there is this, what you have is a donation, you have, of course, the application under various categories. So you have application of income, and then amounts to be disallowed from application. And in amounts to be disallowed from application, one of the clauses is this, and it says, donation to any person other than a fund or institution or trust or hospital or etc. is referred to in subclauses 4, 5, 6 or 6A of 1023C, or trust or institution referred to in 11 or 12 of the Act. Now, you could very well have an entity which is a charitable organization. They may not have been registered under Section 12AB because today they may feel that I don't want that restrictive regime, so I may still be charitable, that's one. There may be another entity which is, say, a small school or a small medical institution whose gross receipts are less than 5 crores, or which is wholly or substantially financed by the government. Now these are classes which don't need to be registered under clauses 6 or 6A of 1023C. Now, does it mean that such donations are required to be reported here? Now, if you have reported over here, it would mean that this is treated as disallowable, and automatically a 143(1) intimation will come saying that this is to be disallowed. And therefore, I would suggest that don't report such items over here. And I would suggest that in that particulars which you're giving in that audit report, you mentioned that such categories which are not disallowable, because there is no specific provision for saying that you have to give only to these organizations which are approved under 4, 5, 6 or 6A or under 12AB. It's only those which are eligible, you can give donations. So it doesn't say that. And therefore, I would put it as one of the things which the auditor will have to report in his audit report, saying that on this basis, since these are not disallowable, these are not reported in that particular clause. That's the way I think the audit should go about it. Sorry, one point I think there also in this there is bifurcation which you are required to give on application of income between revenue and capital. Now, which Sonali referred to, I think, in her this. The question is, when you're looking at revenue or capital, you have to look at it vis-a-vis the trust. Say, for instance, if the trust is buying certain equipment which is donating to another trust, now that will be regarded as revenue for that trust and not as capital. So that's what, so the principles of revenue or capital which have been laid down by Supreme Court, etc., where you say you're giving to the government for a particular capital purpose, that is not a capital expenditure, your capital expenditure, it's a revenue expenditure. So that's the principle I think which a trust will have to follow.
Yes. Now the answer, because this particular question has been doing the rounds on various WhatsApp groups, my answer that I am going to give may not necessarily be fully palatable, but if you read 115 BBI, which is a charging provision, then to my mind the consequence of if your expenditure or your amount that you have set apart exceeds 11.2, the explanation to section 11.1 and the 15% what is termed as a statutory deduction, though that is not so, and there is something which remains, will that go tax free if it is below 2,50,000? To my mind, it will not go tax free and it will be taxed at 30%. The rationale of this is that whatever income from property held under a trust is exempt subject to the rigors of section 11, which means that accumulation up to 15%, accumulation beyond 15% subject to the conditions of 11.2 and 11.1 explanation. These are the three parameters in which income can be spent, accumulated, etc. To my mind, this may be, I do not get into the minds of the lawmakers, but this possibly gives a even level playing field, because while to an AOP there would be a non-taxable limit of 2,50,000, that same would not be available to a section 8 company today. So therefore, to my mind, yes, if your amount accumulated or set apart exceeds what is permissible under these provisions, then it will be taxed at the maximum marginal rate, which is 30%, which is a consequence which will flow. Unless one is able to take a very, shall we say, technical argument to say that then you are putting certain entities on a different keel and therefore everybody should get to, like, I don't think that argument will survive. So today, to my mind, the legal position seems to be this, that if something which is accumulated or set apart, it does not fall within the specific provisions, it will be taxed. Yes.
Yeah. So I think there is a slightly different view also possible. While I agree with Anil that this seems to be the intention that this 2,50,000 should be regarded as amounts accumulated or set apart, which is not permissible, otherwise permissible under the Act. I'd just like to draw the attention that Section 164(2) still continues on the statute books. 164(2) talks about at the rates applicable to an AOP is one aspect. And the rates applicable to an AOP are the rates applicable to individual HUF, AOP or BOI, which includes the slab rate. That's one angle. So this distinction anyway has always been there. That's one. The second is, how would you give meaning to Section 139(4)(a)? So unless exceeds the maximum amount not chargeable to tax, the 2,50,000. That means they want to say up to 2,50,000 anyway your income is exempt, so you don't need to file your return. So 139(4)(a) which requires you to file your return, and therefore that view is possible. The third thing is, there is a Bombay High Court decision in the case of CIT versus State Bank of India in 169 ITR 298. Now, this was a case where one Mr. Rapticos, who was the founder of Rapticos Bread and Company, a pharmaceutical company, under his will, he created two charitable trusts, one for charity in India, one for charity outside India. And he appointed State Bank of India as the executor of his trust. And now, during the year, State Bank of India did not do anything about that because they said we are still applied for the probate has not come, etc. But they claimed that whatever was the dividend which was received by the trust, it was the shares of the company were settled on the trust. So they said that 25%, that time it was 25%, today it's 15%. So they claimed 25% accumulation under Section 11(1)(a) at that point of time. So when the matter went to the Bombay High Court, of course, they said that, you have not taken any action. So whether it is for the trust in India or outside India is a question, was one aspect of it. But the second thing is, when they talked about it, they said, the condition precedent is where any such income is accumulated for application of such purposes in India. In other words, the accumulation had to be a conscious accumulation and not just a mass of unspent or unapplied profits. And further, it had to be done for application to charitable religious purposes in India. So what they said is, therefore, accumulation means a conscious act of accumulation, and therefore, perhaps a view is that for accumulation, and you will have to therefore pass a resolution to accumulate it, conscious act. Let me warn you, if you do this, but please ensure that even for your 11(1)(a), the 15% which you accumulated, please pass a resolution if you want to take this view that yes, this is not an accumulation and therefore 115 BBI does not apply. So please do that, is what I would suggest. But whatever, if the trust chooses to take this view, I think the auditor will necessarily have to make a disclosure that based on this, the trust has taken a view that this is not an accumulation and is only an unspent profits. That's the...
Yes. In fact, Sonali, you can add on to anything that we have said earlier, because I saw right at the outset that you are a part of the panel still.
No, not that. I was only talking about the practical. If you look at the utility of ITR 7, the utility is directly levying tax on whatever is remaining. That means after 15%, assume a trust had a surplus of 3 lakhs and the standard, after that standard 15%, it has left with surplus of 3 lakhs. One would then charge tax. But if even after 15% surplus, if say after 15% standard deduction, if the surplus is only 2 lakh, ordinarily one would not pay or charge tax, but the utility is directly charging tax on it. So for a small trust with surplus of 2 lakh, litigation not advisable, not affordable. So the easy way out is to file Form 9A and ask for option to spend it in next year. Though the date of filing 9A is over, that's beneficial circular extending date is available. So to my mind, small trust should use that option, file Form 9A, so that the litigation is avoided, because CPC might just tax it the moment the surplus is there. That's all.
Yes, I do concur with Sonali, and while I entirely appreciate the arguments or the possible arguments which Gautam elucidated on, you will then have to meet one more argument is as to whether a specific provision like 115 BBI would override the second proviso to 164. While undoubtedly I would be more than happy to argue the line of argument which Gautam suggested, I don't know whether it's economically viable for a trust to take that line. But yes, this is a controversy, and maybe if there is a clarification, one should ask for a clarification, which then certainly will be in the negative. So to that extent, one will have to go.
No, 164.2. See, where exemption, income is not fully exempt, is not exempt under so and so. So therefore, once you have exhausted your exemption, then whatever income is left, say you have 5 lakh income left. Now, so I'm just saying, Anil, the point is it may not only be 2,50,000, it may be a larger amount.
Maybe.
Today I might want to take the benefit of up to 5 lakhs, say for instance. So therefore, but it's something which I think from a practical perspective, yes, it's advisable not to litigate.
No, I appreciate. I am arguing the devil's advocate.
Yeah,
it's saying that, look, your income is exempt provided you spend up to 85% or you go under 11.2. Otherwise, your income is not exempt. Now, what we are trying to say is that, all right, we are falling within the exemption, but we want to take the benefit of the nil tax rate which is applicable to the first slab of 2,50,000. If I were in the government, I would say that I am giving you this relief subject to these conditions. You should have spent 85%. If you not, maybe. I said I would love to argue this the other way also, but then I thought that better, so possible argument, especially
that the language uses accumulation under 115 BBI. It doesn't say unspent amount. It talks about accumulation. That's the utility. Well, obviously the return utility automatically taxes, and which is where I think one will have to be prepared for litigation.
Yes, litigation. Anyway, so next question. Yeah. Now we'll take questions at the end because time. Okay, 39C4. Yeah. The question is, are amounts given to needy individuals by way of relief of poverty, education, medical assistance required to be reported? Now, 39C4 is falling within the clauses that, yeah. No. Yeah. 39C.
Hello.
4. Expenditure in the form of contribution or donation to any person. So, the question is whether this needs to be reported. Now, clause 13.3C4 are amounts given to the needy individuals by way of relief to poverty, education relief or medical assistance required to be reported. I really don't see why it should be required to be reported if whatever is spent is falling within the objects of the trust, because it is, I think, amounts disallowable, right? So therefore, according to us, it should not be reported, but yes, the auditor may, if he so wants, disclose the fact that yes, this particular amount has been spent. It is not falling within the other categories of 39, but it is not disallowable for this reason. I don't see any reason, and this is possibly through a representation this can be got over, because if it is falling within your objects, it does not fall within reason as to why this amount should be disallowed as an application at all. Next.
Yeah. So question 17 is under clause 41, you are required to give the details of specified person as referred to in section 13.3. Now, one of the categories of specified persons, as you know, is a substantial contributor, And a substantial contributor is defined as somebody who has given donations of more than 50,000 since the inception of the trust. Now, where you have a 100-year-old trust, somebody given 500 rupees for last 50 years, you would still fall in under that, but it's ridiculous, that limit, etc. But that apart, the question is, what is, in one of, you are required to give the code of the person, the name of person, PAN of such person, Aadhaar number of person, if allotted address, and specify the amount of contribution made to the auditee if he is a substantial contributor, category of substantial contributor. I think the whole objective here is to see that is he a substantial contributor, to what extent is he a substantial contributor, and therefore you need to give the aggregate amount of donations is my view over here. I think though it's a report for the year, but because the details have been maintained by in the case by the trust, and practically, what happens in many trusts earlier were not maintaining such detail. What I would advise is that in such cases, at least for the last 2 or 3 years, maintain a detailed contributor-wise with column for each year and having the total, etc. So that at least the auditor can report that these details have been maintained for donations with effect from so and so year at least. So because not maintaining that list at all is asking for trouble, is my view, is asking for litigation, and therefore it's something which I think trust should start compiling at least for the last couple of years, if not last 3 years, if they can do it. I think it's something which will definitely help reduce the risk of litigation in this situation. Under the same clause, the question is giving of the PAN and Aadhaar of every specified person, including substantial contributors, mandatory? And that is where the problem really is. If you see the columns, it talks of PAN of such person and Aadhaar number of such person if allotted is what it refers to. But if you look at Rule 17AA, because this flows from in a sense Rule 17AA, which requires you to maintain records, etc. Clause D9 talks about details of the name, address, PAN and Aadhaar number if available. So whether that if available applies to both PAN and Aadhaar number is a question, but I think at least one of them you should have is what I would. The practical difficulty is that you are not only required to have the names of the donors, you are required to have the names of their relatives. Now this is practically impossible. If some donor comes to you saying, I'm giving you 50,000 rupees or 1,00,000 rupees, and you tell him that I will take this donation, provided you give me a list of all your ascendants, lineal descendants, your brothers, sisters, everybody, children, grandchildren. Now can you imagine which donor will say, no, forget it, I'll just go. That's the... so this is practically impossible, and therefore I think in such a situation one will say that it has not been possible to maintain this list of the things since donors have this information not been forthcoming from the donors. That is something which I think a trust should mention. At least of trustees, yes, you can make them give the details of the relatives. But of substantial donors, I think is something which maybe one would want that to be mentioned, that it is not practicable. The donors have not been forthcoming with that information, and therefore it has not been given. Yeah.
Yes, 43 subclause A, where it amounts to a specified violation. Income of the auditee has been applied other than for the objects of the trust or institution. The question is that is reporting required even if minor amounts spent on other than the objects of the trust? Now one may believe that ultimately if I am doing charity, why does it require to be reported and why does it come within the ambit of specified violation? Remember one thing is that your exemption under section 11 is circumscribed by the conditionality of 12A, which means that you register a trust in terms of what the objects that you are going to apply your income on. And it is only that application that enjoys exemption subject to the limits of section 11. However minor it may be, an expenditure which technically does not fall within the objects of the trust is ultra vires the powers of the trustees themselves, because they never could have applied it that way. It may be small, undoubtedly, maybe 1%, and it may be in fact a application for charitable purpose, but that's not enough. That charitable purpose has to satisfy the mandate of your objects. If it does not, to my mind, unfortunately it will have to be reported and constitute a specified violation. Next.
Yeah, and which could result in the cancellation of registration.
I appreciate. But then, I don't see, technically speaking, unless one interprets a particular object, because the question is very specific, other than the objects of it. So, we faced this problem earlier that a very large institution which is primarily educational, and this problem is now going to, just bear with me for 2 minutes. This problem is going to compound itself. 1023C requires your objects and educational institution to exist solely for the purposes of education. Now, an educational institution is a part of society. Suppose there were a calamity which is hitting the nation, and an educational institution, in order to satisfy the parameters of 1023C, restricts its objects only to educational object. Can it donate for flood relief? The answer is no. If it so donates, does it constitute a specified violation? The answer is yes. So therefore, the point is, once we read the law in the manner in which it has been so read, then these are the consequences which will follow. So unless you are able to fit in, unless you have a residuary clause, any other object of charity, this could be some degree of difficulty. 43F and schedule other law violations. Should reporting be of non-compliance with any requirement of any other law, or only of requirements material to attainment of objects? Now again, as I said at the outset, that we have to look to a purposive interpretation of this particular rule read with the report form. Section 12AA empowers cancellation in a scenario where you violate or infringe law which is material to the attainment of your objects. If the violation concerned is not material, for example, there is a vehicle of that particular trust where some taxes are unpaid and things of that sort. Do you need to report? To my mind, you don't need to, for the simple reason that that reporting, it again will remain depend on facts of the case. If that infringement or infraction is such that it has got no impact on the activities, application of income, then I don't think it has to be reported. However, the auditor, if such an infraction does come to his notice, would be well advised to report that in his observations and say that the auditee has taken a particular view in this regard, that this, for this reason, does not fall within the reporting requirement as is contemplated by 43A.
Next question. Yeah. So this is on relation to depreciation. As you know, section 11.6 says that if the cost of acquisition of any asset has been claimed as an application of income in the same year or in earlier years, then depreciation is not allowable. So therefore, this clause 44 requires you to report where there is any claim or has been made in respect of any asset, acquisition of which has been claimed as an application of income, and what is the amount of such depreciation. Now, when you are looking at application of income, therefore you are looking at application out of current income is one situation. Second situation could be application out of accumulated income. So which is you've accumulated 11.2. Now that is also an application of income in a sense. And the third situation could be where you have exercised the option to spend in subsequent year. That also is an application of income really which you are claiming. Now there could also be one more situation where say you have claimed, you've sold a capital asset and acquired another capital asset. That capital asset could you're claiming depreciation on. Now there under 11.1A that is a deemed application of income. So therefore I would feel that that would also be covered under this situation. But if you acquired an asset out of corpus, now earlier as you know corpus was exempt if there was specification of the donor, there was no other requirement. So it was the donation which was being claimed as exempt and not the application which was being claimed as exempt. So if you had acquired an asset out of the corpus, then that was, you could be entitled to depreciation on that. So now also the position is that of course corpus is exempt if it is invested in a specified asset. And if you then spend out of the corpus for acquiring that asset, that is not allowed to you as an application of income in the year of spending. It will be allowed only in the year in which it is recouped. So therefore, in a sense, that what you are doing there is the asset in such situations, unless there is a recoupment, there is no, the asset has not been acquired out of application of income, is the way I would look at it. And therefore, if it is acquired out of corpus donation, one would have to distinguish between a corpus donation which has been recouped and a corpus donation which has not been recouped, is the way I would look at it. The next question.
Yes. You want to take it? Okay. Under clause 45 is the auditor reporting on the computation of income, which is not a part of the books of account. What precautions should the auditor take to ensure? Obviously, yes. 45 is asking you to say as to the claim which is made by the entity. As I said in my answer to the earlier question, in such a scenario, when you are submitting your audit report prior to the entity having submitted its return, you should take a certified copy or a certificate from the trustees that they would be filing their return on this basis, because in that computation would come that particular claim. That is the only recourse that I could think of as far as compliance with this clause is concerned. Next. All right. Very tricky question. Details of income applied outside India is an overseas remittance made to be shown under this table, even if it is used for objects within India. Example, foreign music teacher paid for teaching music students in India through online means. Now, because there are significant implications, I'll dwell with it in around 3 or 5 minutes. If you look at 11 says the exemption is available to income derived from property held under trust wholly for charitable or religious purposes. So the income is for charitable or religious purposes. To the extent to which such income is applied to such purposes in India. So therefore, prima facie, a mere remittance outside India to meet an expenditure where the purposes are intrinsically purposes in India need not be reported. For example, I am carrying out an activity which requires some equipment to be imported, for which I make a remittance outside India. The purposes are intrinsically Indian. To my mind, that does not need to be reported. The second class of remittances would be those remittances where the connection is intrinsically with, or connection is of a dominant purpose of purpose charitable in India. To give an example, if you are wanting to popularize Indian music or Indian dance, teach them to Indian students, you may possibly want to display your talents outside India. If the purpose is ultimately to benefit your population in India, there is a case to urge that that is application for purposes in India, though the expenditure may have been incurred outside India, a grayer area, but yes, possible to take such a view. The case that has been cited to me, of course, is clearly to teach students in India, so that would clearly fall within purposes in India. But even the second case which I advocated, there may be some case, as long as you show a very strong nexus with purposes in India, I think there is a case to argue that that application is not application for purposes outside India. Because 11(1)(c) is falling within a totally different category. That is talking of international welfare, where trusts are incorporated after 52 or post 52, and in both cases you require the permission of the board. The third category would be clearly where the benefit is to charitable purposes outside India. For example, you hold a camp of doctors to treat patients outside India. You may be having a charitable purpose, but that does not benefit people in India. So therefore that, to my mind, would clearly have to be reported. So these are the various three categories. There could be a variety of circumstances, but I thought I would broadly bring out the three categories. The first need not be reported. Second, there could be debate. Third, certainly requires to be reported. I think we are right on time.
Anil, sorry, if I may supplement, I think on this there is a controversy. See, because of the language of the section, it says applied to such purposes. No, so whether that applied in India applies to applied or it applies to such purposes, and there is a controversy. Let me just point out, there is a Delhi High Court decision in the case of National Association of Software and Services Companies 345 ITR 362, where Delhi High Court has taken this thing is that there are three questions which arise: apply what, apply to what, and where. The answers would make the question. So the answer to the first question is apply income of the trust. Second question is applied to charitable purposes, and the third question will be applied in India. And therefore, to such purposes in India qualifies, is what they've said. So therefore, there what had happened is NASSCOM had organized an exhibition outside India to showcase Indian software companies' expertise, so that the benefit was flowing to software companies in India. But there the Delhi High Court said, no, that expenditure is not to be allowed as an application of income for charitable purposes because it was applied outside India. That is the question which is. Now, the contrary decision is that of the Karnataka High Court in the case of Ohio University Christ College, 408 ITR 352, where teaching services were rendered to an educational trust by faculty members of foreign university, and this foreign university was paid certain amount for the use of those faculty members. That these services were utilized obviously for imparting education in India, and merely there the Karnataka High Court said merely because payments are made outside India, it cannot be said that charitable activities were conducted outside the country. There is a Bombay tribunal decision which again, where there was a trade delegation which went abroad and incurred expenditure for promoting trade in exports out of India. There in 68 ITD 95, Gem and Jewelry Export Promotion Council, the Bombay tribunal had taken a view that that would be eligible, it would be application of income. There is Jamshedji Tata Trust, there's another Bombay tribunal decision where they said that was grants given to Indian students to pursue education abroad. Now the grants were fortunately given to the students in India, which they used it for paying their overseas fees. So the question was, is it application for purpose outside India? And there Bombay tribunal said no, you have to look at the application. So in a sense they followed the Delhi High Court. The application is in India, they said it was paid to the students in India, and therefore that was Bharat Kalanjali Madras Tribunal 30 ITD 161, again, that the relevant consideration is whether the situs of the application of money and not the place in which the objects become effective. And where they had took a view, again following, having a similar view to NASSCOM is what they had taken over there. And also CEO clubs has taken a view that it amounts to purposes in India, that holding of conference abroad would not make activities of SSC being carried out outside India. Benefits go to the SSC and its members, and therefore it cannot be said that this is used for charitable purpose outside India. So clearly, I think there is a divergence of view of the tribunals and the high courts. Whatever view which one takes, I think it's important that one document saying that this is not being reported. Because if you look at the language of the reporting does not talk about for charitable purposes. It doesn't say for purposes. It just says applied outside India. And therefore one will say that, saying that this is the view which has been taken and therefore this is not being included. Items which are like this have not been reported. That's the view I think which one will.
As Gautam says, if you report, then you will be saddled with that particular disallowance and whatever happens. So the principle which I think emerges is that you will have to show significant connection with India and Indian interests. If that you show, you have a case. Otherwise, there could be difficulty. That's the principle emerging from all these rulings. But as I said, the auditor needs to take care, and if disclose this application in his observations, because otherwise he would be, hauled up. So that's important. I think yes, just 5 minutes.
Yeah, I think
we can take questions.
Yeah, questions from the floor now we can take, I think, one by one. If
Now we were taking this example, say some case law are favor of SSC, some are against. We are citing this quotation in the note. Then it becomes a debatable. Then CPC can't do anything.
I agree, but what is important is therefore you will not include it saying that this has not been included because based on this case law. So today...
You have to give notes, you can give, there are first part gives say subject to this.
No, so would you say that therefore you will include it as saying that this is a remittance made outside India? If you include it, 100% under 143(1) itself, this will come up. And what I'm saying is...
See, audit reports say subject to following observation, audit first part. So this we can mention it.
No. The question is, if the SSC himself puts it under a disallowable category, can the auditor then say that no, it is allowable? So that's what I'm saying. So therefore the correct way to report it is that the SSC says, no, this is not disallowable. The auditor says that, okay, the SSC has taken this view and therefore has not treated it as disallowable. That is the correct way to approach.
Based on particular case law.
Based on case law.
Correct. Debatable.
Exactly.
Let him finish.
Regarding section 115 BBI, even in those cases where the gross total income itself is less than 2,50,000, for example 2 lakh rupees, and practical application is just 25,000, even in those cases the remaining amount is taxed at 30%. So is that also the intention of the department or some drafting error is there?
I think based on the return form, etc., it seems that is the intention. Earlier, I remember I had talked to this DIT exemption in Mumbai around 6 months back before this return form and all that came, and I asked him, what is the meaning of this 115 BBI? So his thing is that maybe if you filed an application for accumulation under 11.2 which is not eligible, etc., that sort of situation was what the intention was. But the way it seems that the intention is to cover this, though, as I said, whether, how one can try and get over that is a question mark, is matter which we'll have to look at.
So that means in all the cases, either we have to take 11.1 or we have to take 11.2 in almost all cases, unless there is gross deficit.
Correct. Or the exercise the option to 11.1, where you say that, I will opt to spend it subsequently.
And secondly, when there are disallowances under section 48(3) or disallowances related to TDS, we have to disallow certain amount, we will add back to that income, so practically the amount of application will get reduced. Resultantly, we will have to increase 11.1 or 11.2. This will not have any adverse impact on the trust. They will not feel that they are penalized for non-deduction of tax or making a cash payment of 10,000. So personally, I feel that from next year, perhaps this type of violation also will be covered under section 115 BBI. Otherwise, trust will not implement the proper system of not making...
No, see, today, let's put it this way, for a business, if you don't deduct TDS today, but you deduct it tomorrow, you are eligible. Then why should a trust be put at worse footing? Are you trying to advocate that trusts are worse than businesses? Is that
not that?
No, I mean, that's the thing. Because if today a business is getting it, why should a trust not get it?
Okay. So trust must follow those practices.
No, it's good to follow those practices, but there are mistakes which happen.
Yeah.
So genuine mistakes always happen, and the question is, should we be given an opportunity to rectify that mistake? Okay. Or should we say that, no, I will cut off your head now? So that's the question.
Because practically what I have observed is more than 40% trustees still believe that TDS provisions are not applicable to them. Cash payment more than times, we are doing this and that, and why should we?
See, unfortunately...
Practically, while discussing this thing across the table with the trustees and accountant, it becomes very difficult.
But that you have to tell them that this is the law and I have to report.
Yeah.
I have no choice.
So
that's the...
Thank you very much.
I always, this always is put to us every day that we are doing charity and this is unfair and this is what should happen. I tell them that the address of the finance minister is a block. Your representation should flow there. One more aspect I needed to point out, because that is what, when a violation under 40A 1A occurs, there is a remedy. You can pay a tax at a later point of time and possibly get the claim. No such claim survives under 40A 3. And the solution that is often advocated is that you accumulate under section 11. Remember, you can accumulate something that remains with you. So if you have spent money from your coffers, take a case that you have spent 30 lakhs in cash out of your coffers. There is nothing that remains to accumulate. You jolly well pay tax and get over it. That's the long and short of it.
Yeah, you have to invest it also.
Yes, so therefore, people say, why don't you accumulate under 11.1a or 11.2? It's not possible. Once that infraction occurs, the default is complete.
One more thing is the TDS schedule, which is here. It's like that form 3CD, which has columns tax not deducted or tax deducted but not paid. As you all know, the tax department is initiating prosecutions in cases where tax is deducted and not paid. Now, this information for trusts were not available with them on platter today. Now, as you rightly said, 50% of the trustees says we are not aware of this, but now with this, when notices in thousands and lakhs will start coming to the trustees, they will get educated by this, that this case is not going to continue.
An educational trust having education fees of 3 crores and rental income of 2 crores, and out of that their expenditure is around 2.5 crores. Whether this rental income will be
Yeah, so in fact, we are just discussing this, before this seminar. I think the question is, now my view is, frankly speaking, it depends on what type of rental income you are earning. Is it a passive earning where you're just merely letting the premises out and you're earning a pure rent? Then it's like putting your money, you see, you have one type of asset, money, which you put into a bank and you earn interest on it. So it is similar to that, is one view, which particularly if you've given it on monthly rental. And there I would say that is not a business, that is not activity at all, because it's a passive letting out. Just like you can't say that we earn interest on bank. I mean, I've seen assessment orders, of course, where assessing officers allege that interest on bank fixed deposit also business income is what they allocate. But I think clearly, I don't think any person in the right mind can take that view. So similar to this, if it is a pure passive rental where you earn a fixed amount per this, and you're not giving any facilities with it, nothing. But if you are giving it, say, on a daily rental where you're saying, I will give you the facility of catering, I will give you the facility of other support, this, that, etc., decoration and all that, then I think it would clearly constitute a business. So I think there one has to therefore try and ensure that one falls under the passive income category, and therefore one takes a view that it is not a business activity, is the view which one can, it's not an activity at all in that sense. And
yes, we are having a full building where we are running a school from first floor to fourth floor, and ground floor we have given only 3,700 square feet on rental basis to a bank.
Correct. And bank also, you can say that the bank, your reason because you want to collect school fees, etc., it's for convenience, etc. Yeah. That's also, so therefore, one has to link it, and therefore, so it's a question of, what are the facts and what are this. See, you have to ensure that when you're doing things, see, today, let me give you a classic example of a business situation. Today, you have a building which is in a dilapidated condition. You have to necessarily redevelop the building. You don't have funds. So what will you do? You will say, okay, I will demolish this building, I will put up a bigger building, load on FSI, etc. And I will sell off part of the property and fund the remaining cost of construction. Correct? Would that be a business? If you do it yourself, yes, definitely. But if today you enter into an agreement with a builder, saying that, okay, you do this thing, etc., you do all the construction, you sell off whatever this thing is, give me X area, etc. So what are you doing? You are merely realizing one capital asset and getting another capital asset in exchange. So therefore, how you do it is now extremely important so far as trusts are concerned. I think this is, you say that, no, but I will get more profit if I were to do it myself, then you will lose your exemption also. That's what you have to remember.
In fact, I agree with you. The test is your activity. In the sense, that is the real test. As Gautam, if you are passive and you are only exploiting assets, then that would not result in an infraction. And why I am saying this, is that many a time we are met with this scenario, typically of trusts which have large buildings. They give out their halls. Obviously, those halls are then used for marriages, etc. What the trust tries to do is then maximize its revenue by saying that we will permit only a monopoly caterer and we will charge a royalty. That's a sure dead giveaway, in the sense that is something which, because then you are exploiting your asset to maximize it. It's virtually like a commercial proposition. So that is, because I've seen people come with me to queries with a resolution that we tendered and the person who offered the maximum amount for monopoly, we have granted. So that this will create difficulty.
Yeah. So also, if you look at New Noble Education Society's case, the Supreme Court in that case observed, where they talked about an institution which is letting out its hall, educational institution letting out its hall when it's not required for educational purposes, letting it out to outsiders for carrying on their own activities. So where the activities are not that of the educational institution, so anybody can take up by paying a fixed amount. He said that will be considered under other heads. They have not said that it will be considered as a business, etc. They said that will be considered under other heads. And that's where I would draw support from, saying that that is not an activity and therefore possibly it's not a business at all.
And a educational trust running a CBSE school, but we are also having Gyansala for teaching Jain religion. Will it be a religious activity or it will be educational activity?
See, what is the distinction between religion and this is, I think, you have some tribal decisions saying that teaching of the Vedas is not, because Vedas is a way of life, etc., and therefore it's not religious, etc. But to my mind, it's a dangerous territory. It's something which I would advise that have a separate entity do that rather than don't mix it up with your educational activities. Because there, to my mind, it will highly likely that, this will be treated as religion. See, let me tell you that I have seen trusts which in the past used to try and disguise certain things, say that, no, this is received as donation and though it is actually for rental, etc., things like that. But, now what you have to understand is that the department also has all the information readily available. You have their website, they will look at public available information, etc. So therefore, never try and disguise your facts or your this thing. So try and ensure that your activities are organized in such a manner that they are clean, that they are very clear. So therefore, have a religious trust separately, which will carry on this activity rather than mixing it up with your educational activity, is the way I would look at it.
Suppose...
I think some other people also have questions. I think too many questions. I think, yeah, let them also.
Hello.
Hello, sir.
Yeah.
Sir, just one clarification I seek from you. Sir, in case if the trust has not commenced its activities, trust has not commenced activities and it is deriving, say, income in the form of interest from securities by way of 11.5 and its total income is below, say, 2,50,000. Would it still, just actually ma'am mentioned that the utility may try and do a taxation. Okay. How would it?
I would suggest practical ways accumulate under 11.2, say that I will spend it in the next 5 years is the practical.
Sir, but in this case, if I have not commenced activity, okay, then how do I actually go about it?
See, the question is you've got provisional registration.
Yes.
So you have provisional, therefore you're entitled to 11 and 12. Once you apply 11 and 12, the return will automatically treat this as taxable unless you accumulate it under, or unless you want to get into litigation, as I said, that there is a view possible, but that's.
Can I ask a question? Okay, I'll just ask my question really quick. An education institution which is registered under 1023C has obviously made an investment under 11.5 into bonds which are allowed to be invested, they are government bonds, and there is a premium paid. So ideally what a trust would do is when the premium is not paid back, they would debit the income and expenditure account. My question actually is that since the law is now applicable to 1023C trust where actually on payment basis is what you can get an exemption, can I now say that the premium I paid and debited to my investment account can be claimed as an expense for the year?
See, I would look at it as, you have to look at your net income. So here you have a gross income, say, of 100. You have this premium which has been debited, say, which is of 10. So your net income is 90 is the way I would look at it. That is your commercial concept of income. Because for trust, you have to look at the commercial concept of income. And therefore, I would say that, look at it this way, that in the year in which that loss is realized, that's the year in which you claim it, is on maturity of those bonds.
Hello. Hello, sir. Trust has invested in a notified security. Now that security has become bad. How it is to be treated for the current year?
One way is that you write off that security is your books, obviously, because of the fact that now it has become unrealizable. You'll have to see in which year it becomes unrealizable. And therefore, as I said, again, the same situation. You take your net income. So your gross income less this loss on security which is written off, and that's the way I would say, that's your commercial income. No, see, it would not be reported as a disallowable. No? Under which category are you looking at? This is not an expenditure, the way I would look at it. It is part of your income, because what is your income? Your income is your total of your incomes and losses. That's the way I would look at it.
Good afternoon, everyone. Sir, objects of the trust, there will be direct expenses, educational, medical, and there will be operational expenses like staff salary, rent, electricity. Now, 85% is there of both the expenses, objects and operational expenses. Now, is there a sub-limit, and the reason why it is not there for operational expenses? Like say, if 100 is the donation received, can we say 70 are the operational expenses, only 20 are for the direct objects, and 10 is the resultant?
In fact, when you say operational expenses, you don't incur expenses just like that. No? Those operations are also necessary to carry out your objects. So that is also expenditure towards the objects of the trust. There is no sub-limit except under two different legislations. One is of course CSR, whether they would have a limit, and FCRA also itself has a limit. So these limits are only under those two.
Hello sir, I want to know whether this change format is also applicable to Section 8 companies?
Yes, of course.
Okay.
I think Rajesh. Yes, but Rajesh has to.
Gautam.
Thank you.
Yes, Rajesh.
Anil and Gautam. Yeah, no, I think there are a lot of people on the online.
After this question, we take online questions.
I've been privileged for the last question. Thank you. Okay, the question is that where a charitable institution is conducting a hospital for the medical relief, and for that purpose is not charging sufficient income, so therefore either the income is minimum or it is a loss something, but it runs a medical store wherein the medicines are being given at the MRP even to those who are coming from outside as outside patients, and from there is a surplus generated. So how is it likely to be considered for 215?
See, this is an incidental business, maintain separate books of accounts, because this is part of your, today primarily why are you having the pharmacy? Because you want for your patients. Incidentally, you are selling also. There are Bombay High Court decisions, Bond Foundation.
Hinduja is there.
Correct, Hinduja. There are a couple of the same, yeah.
3 or 4.
So 3 or 4 decisions of Bombay High Court and Bombay Tribunal which have held that yes, this is something which is an incidental business, and therefore, but maintain separate books of accounts for the pharmacy, very clearly.
That is better.
Yeah, but from the hospital there is no income, like, or maybe a loss.
That's fine. You transfer surplus every month from the pharmacy, you transfer it to the hospital.
Thank you.
Okay, I think now online questions we can take. Sorry, we can't hear you.
Can I ask you? Hello?
Yeah, please.
Please.
Can you hear me?
Speak.
Ketan, can I request Kasturi to maybe ask the question first?
My question is, are you able to hear me?
Yes.
Yeah, my question is, my income is more than 2,50,000 and my trust has not spent 85% of its income. Then basic exemption limit of 2,50,000 is available or not?
Well, I think the answer to that, I think any other participant will be able to tell you who's been listening to the discussions which you had. I think, I think that's me.
Next.
My another question is, I have 4 educational institutions, 2 are grantable and 2 are not. In that case, how as an auditor I can report of my trust under section 1023C?
Sorry, we've not understood your question.
My trust has 4 educational institutions, 2 schools are grantable and 2 schools are not grantable.
Grantable or not doesn't matter. Grantable or not doesn't matter. The SSC is the trust, and the trust is the one which will have to you'll have to look at as a whole.
Okay, and my last question is, my income is more than 5 crores. So which is the revised form other than form 56 for granting the approval?
What approval are you talking about? Registration.
Which approval?
You are talking about the registration. This. So if it's for the first time, it's Form 10AB. If it's renewal, it's Form 10A.
10A.
Yeah, anybody else online has a question? I think Ketan, if you can try,
Hi.
because we couldn't hear you earlier.
Yes, sir. Hi, sir. This is Shyam. Hi.
Yeah, Shyam. Shyam, if I could request Shyam to raise the question, please, first.
Yeah, sir, in the light of recent amendment where inter-charity donations are allowed to the extent of 85% only, now suppose we have a very big trust or a non-profit organization registered under Income Tax Act, and so the trust per se wouldn't have the reach to do the activities in remote areas. Okay, now, and there are various NGOs which are undertaking this task. Now, these small NGOs which are there, through them the trust would undertake the programs and activities towards its. Now, these small NGOs are not able to procure funds apart from this well-known trust to carry out their own activities. What would be the possible way out for this?
See, can I just, this is from assessment year 24-25. I think it wouldn't relate to the audit for this year. So let's first take the questions from people who have on the audit.
This year.
I think Nandini had some questions.
Hi.
Yeah.
Hi.
Sure, sir.
Yes.
Sure.
Hi, sir. Nandini here. I just have a couple of quick questions. One, this relates to the Supreme Court rulings in the case of New Noble and Ahmedabad Urban Development. So, if we look at the New Noble ruling, there is a reference that, or there is a remark that only those institutions which provides formal scholastic training will be considered as carrying out educational activities. But what we've seen is there are a lot of charities which don't necessarily, run schools or colleges, but still work in the same educational space, such as, providing courses which help bridge the gap between, the underprivileged students and the regular school-going students. And basically, there are a lot of NGOs which carry out activities which are on the lines of education, but not necessarily in the form of schools or colleges. So my doubt really is, if in case of these institutions, should they report their objects as education in this clause 11 where we have to report the objects of the auditee, or should they, in their case, probably to what could be another object which will be suitable for their activities is probably relief of the poor. So my doubt really is if they should continue reporting as education, or if they should change to any other object where they'll fall under, probably relief of the poor. And if they do so, should they also then respond positively to the following question, which is basically whether they've undertaken any change in their objects.
See, Nandini, we have understood the question. New Noble was in the context of 1023C. So the words solely for the purposes of education were interpreted in that context. Yes, they did say that in that context education should be scholastic education. But if you fall purely in education, as you said, you can satisfy the term education independently as is appearing in 215. Then I think you should still report your objectives of education if you are claiming 11 and not 1023C.
Anil, I have a slightly different view on that. Because they said that for the purpose of section 215, education means formal scholastic education is what they said, and they refer to Lok Shiksha Trust. Lok Shiksha Trust was in that context, and therefore I would feel that in this situation, see, let me tell you also that other types of education, say for instance for bankers, you have the CAIIB course which is there by Indian Institute of Banking and Finance. That matter is currently before the Supreme Court, and I think the hearing is scheduled now on 6th of September. I don't know whether it will be come up for hearing or not, but that is an issue which is still before the Supreme Court for decision. Whether, because formal scholastic education saying that only that and nothing else, I think is, too far-fetched in that sense, is what one felt. Because you had earlier, Justice M.R. Shah, when he was in the Gujarat High Court, he took, in Ahmedabad Management Association, for instance, he said that management courses for executives would amount to education, is the view which he had taken. And therefore, I think is something which there may be some sort of relook by the Supreme Court. But for the time being, I mean, whatever is the view you take, you better, see, it's not a change in objects. Your objects are still the same. It's only the classification of objects, because of the law, the interpretation of law which is undergoing a change. Whether you would say under general public utility or relief of the poor, etc. So that's a question which is a call which you need to take, whether you want to do that or you want to continue it as education, saying that this is really education, though it is not formal scholastic.
I have a slightly different
Got it,
view.
sir. I just have one more question. Can I go ahead?
No, I only wanted to point out that what Gautam says is right, but if you see the tenor of the judgment, that starts with the word solely and then goes on to education. So therefore,
but the one more point which I wanted to is in this case, if you don't call it as education and show it as any other object, then the danger of 215 will come in, because if you go under other objects, then it could be treated as business.
Yeah, got it. Yeah.
So
I just have one more question.
yes, I think somebody else also.
Yeah.
So quick one.
Anybody else on online?
Online,
Last question
yeah.
online.
Online,
Yes, sir, I
anybody
have
there?
a doubt.
Yes.
Yes, sir, I have a doubt. While providing the source for expenditure, so I'm writing the amount as like the accumulation under 15% accumulation. I'm providing it as a source of expenditure. So in computation of income, it is treated as income. So is it actually my income or reduction in expenditure, or it should be nullified?
Sorry, what are you talking about? You're talking about which item?
Providing source of expenditure.
Yes, you're giving the sources,
Right, yeah.
because see, what you spend out of corpus is not to be allowed as an application in this year. It's only when you recoup the corpus. If you spend out of accumulation under 11.2, it will not be regarded as application of income for the year. If it is only out of current income, then that's why that sources has to be given.
So the 15% standard deduction which we are getting, suppose that.
That is not an application of income. That is not an application of income, no? That is an accumulation which is allowed to you. It's a separate item. It's not part of application of income.
Okay, sir. Thank you. So I had one more doubt.
Yeah.
I think give chance to
So
other
I have
people.
one more doubt.
Give chance to other people, Nandini.
Yeah, if there's somebody else online, then maybe, you take their questions first.
Sir, I have one question.
Yes.
We are having the interest on FDRs, which are in the investments, but for the there is accrued interest. As per the bank certificate, we are accounting it, but for the accrued interest, whether we should go for filing Form 9A or whether it should be the part of current income only.
So it depends on you. If you're spending, your spending is enough to cover that, your 85%, then it should not be a problem. You can take it as current income. But if you feel that, because there's a significant amount of interest which is accrued but not received, you can go under the expression to 11(1)A and file Form 9A in that situation. So it's a question which each trust has to take based on the facts. Yeah, I think.
Sir, I have one more question.
Okay, Shyam, tell me.
Sir, if there is an educational institution, of course, as a trust who is running educational activities, and where the donations are not sufficient to cater its expenditure, then the trust starts charging its students, or this educational facility starts charging its students some fees for recovery of certain costs. So whether it would be treated as running a commercial activity or something like that?
So it depends. No? If it is only meeting its deficit through that and there is no substantial surplus, should not be a problem. But if you have a substantial surplus, I would just like to warn you, there's a Supreme Court decision after New Nobel, which is in the case of Banda Singh Bahadur Trust, where there was a surplus of 67% of the amount, and they said that in this case, this is not solely for educational purposes. This clearly seems to be for commercial reasons that you're carrying this on, and they denied the exemption. They upheld the denial of exemption.
Okay, sir. Okay, thank you.
In view of these changed circumstances, if the gross total income of the trust is less than 2,50,000, then should it file the return or not?
Aril Sonali, maybe you may want to take that question.
And second question in the same line, if the return is not filed, will that entail consequences under section 115 TD?
Your obligation to file a return under 139(1) is ignoring this particular exemption. So if you are entitled to exemption and thereafter the exemption, you have income of less than 2,50,000, that is after the claim of 11. So according to me, you are liable to file a return.
It's before. He's saying before. My gross income is less than 2,50,000.
Then of course.
Then I can escape 115 TD is what
Yes,
you say.
yes, of course.
115 BBI.
If it's below 2,50,000, then
below gross income below 2,50,000, if I don't file the return, will it entail 115 TD? Department will presume that trust has been discontinued, and then they will
I don't think that.
No, I don't think that's
not been filed.
No, there's no obligation to file a return.
There is no obligation to file a return. What will happen possibly only is that when you go for renewal after 5 years, they may say that you are required to file your return and ask you to file it. In which case, if the form remains unchanged, the consequences which will flow today will flow after 5 years. That's the long and short of it. So
better to file.
Hello, sir.
Better to file. Go for 11.1 or 11.2.
That's
at,
right.
At the end of 6th year or cyclical changes after 6th, 7th, 8th or 9th year, ultimately there will be income which is taxable at the rate of 30%.
So the trust is
Hello,
to
sir.
spend.
Yeah, that is true.
No, so you keep spending as long as you spend.
that's the whole objective.
The whole point out of these new amendment is
You
trust only spend. That's it.
Because there are n number of trusts which do not have potential to spend.
Then they should not have been formed in the first instance.
They have been formed, they are getting income from 1.5 lakh.
So that's the whole point.
Yeah.
Is that the government believes that your exemption is based on application.
Yes.
If you say that we don't have the wherewithal for application, you should not have formed them in the first place.
Just use the mic, please, because for benefit of people who are online.
See my gross, now 15%, how I have to calculate? 1 lakh rupees income, 10,000, say, for administration expenses. So 90 I have to take or 100?
No, there are decisions which have said that administrative expenses, there are two categories. One is expenses incurred to earn that income. If it is an expense, say for instance, you have rental income and you paid municipal taxes. That is expenditure incurred to earn that income, and therefore your commercial concept of income is gross income less expenses incurred to earn that income. Other administrative expenses are to facilitate your charitable objects, and therefore it is an application of income for charitable purpose. That's the way I would look at it.
Sir, we are from online Chotalal Shah. Hello, sir. Hello. Sir, we are from Chotalal Shah. We have two questions.
We'll take one question if you don't mind.
One question.
Okay. One is very practical question for all the persons who are attending. One is 115 BBI under subclause 2. They say the amount of income tax which the SSC would have been chargeable had the total income of the SSC reduced by the aggregate of specified income. So if I have an income, say up to 2,50,000, they say specified income you pay tax at 30%. Then what is the other category of income which will fall under subclause 2?
No, there you're talking about deemed income referred to in 11.3 or subclause.
Section 1
Okay,
subclause
okay. You're
2.
talking about how it would have been had to be reduced by the amount of specified income referred to. So therefore, they're
So what
sort of So therefore, they are referring to. So see, yeah. Anil, maybe that is something which you may look at from.
Yes, yes. So,
So can you have such income then? The question is, because what you're saying is, if the unspent income is an accumulation, it falls under this thing, then there is the question of.
Then what you are saying is that subclause 2 will never operate, is what you are saying.
Exactly,
But,
and therefore that it seems to indicate,
but that again is a highly litigative situation. No? So,
but one more argument in support of the fact that you should get the basic exemption and.
I appreciate, but then whether any entity which is going to suffer 37,000 rupees of tax is willing to bear that degree of expense.
Yeah, I agree. The problem really is, unfortunately, today we have a situation where the forms override the law. Is the real problem.
Yes.
And that is where sometimes from a practical perspective, sometimes one says that, okay, forget it, let's just comply with the form rather than. And that's an unfortunate situation, which I think is something which maybe one will have to take up with this. But the way the department thinks, I think it's their view or no, you can't take an alternate view at all, is, I think, unfortunately.
Hello.
Sorry.
Hello, sir.
No, I think we'll have to stop this. Unfortunately, sorry, Steve. Before we conclude, I would request Rajan Bhai to give some concluding remarks. Rajan Bhai, are you there? Yeah, Rajan Bhai.
Thank you, everyone. Thank you, Sonali, Gautam, and Anil, for the excellent presentations. So people like us, at least a person like me who doesn't understand ABCD of charity, could get a lot of clarity. But more those who are actually participating and who are actually had a charitable trust income, charitable trust issues, I think a lot of clarity has been brought in by all of them. Special thanks to everyone, all the organizations for joining together, for making this program a grand success. 2-3 points, but Sagar Bhai also mentioned at the beginning, at least, is that whatever points we want to quickly get some solution or relief from the board, let us quickly write down and take it up to the board. And I think if we are able to dilute some of the rigors which are being brought out by all of you, we can try for that purpose, because now hardly any time is left. Today we are already on 2nd. If we can give something, we will try our best to take it up to the board and see what they can issue some clarifications which could be helpful to us. I think that is the point which we could consider. And if you can share with us, I think that will be great. We will be able to take it up to the board. Secondly, as I was mentioning at the beginning, the flavor of the litigation appears to be this in the last 2 years appears to be charity, and which is fueled by the Supreme Court decision. I think that's what is happening. And now we have to really struggle with all charities as to how do they survive themselves and later on comply with the law. And if you want to comply with the law, there will be a lot of difficulties which will be faced by them, and they will end up with only litigation and not really relief to the poor or relief to the needy people. Right? That's what is happening. But that's a flavor of the legislation. It swings from one end to another end, sometimes favorable to charities, sometimes favorable to partnership firms, sometimes hard hit to everybody, and then creates a lot of difficulty. But anyway, I think a lot of clarity has been brought in. But if you have still any specific points, I would request, please share with us. We'll try to see that whether we can get some answers from our experts and try to share with them. But we have long queries, like some of the participants are asking long specific query. You'll have to go to these professionals, take their appointment, and go on professional basis some advice. I think everything free advice cannot be answered for the specific queries, that you have to go specifically to the professional people. But general advice, as already they have shared, please feel free. So again, once again, I thank all of them, all associations, for making the program grand success. Thank you very much.
Thank you, Rajan bhai. But I would just appreciate Rajan bhai has taken the lead to plan this program, and thank you very much for being the spearhead and combine all the associations to have this program. In the hindsight, I feel that it would be a one-day, full-day program, then it would be better. Yeah. With this, I would request Chirag to propose a well-deserved vote of thanks.
It is a pleasure to have got this opportunity to tender a vote of thanks to the esteemed speakers. Unlike in tax where we have two views, I'm sure on this we would have one view that there couldn't have been a better composure of the panelists around over here who could have done justice to the extremely difficult topic. I'm confident all of us have gained more wisdom by attending the session. I, on behalf of all the three organizations, which is IMC, BCA, CTC, as well as all the participants, would like to tender a well-deserved vote of thanks to all the speakers for their time and efforts into it. Thank you.
Sorry, please be seated. One second. Mr. Samir Somaya is just joining us, and he wants to.
Samir bhai, you have to say a few words. Samir bhai?
Yeah.
Really, I went to Delhi recently and met the Ministry of Commerce, and I met also Sri Karad, who is Minister of State for Finance, and they both said that, give us concrete suggestions, what you would like us to look at and make easy.
We have lost.
Samir bhai, you are on the mute. Samir bhai, you are on mute. Samir bhai, you have got on mute.
Was I not audible?
No, you had gone on mute.
Can you hear me now?
Yeah, please repeat last sentence.
Can you hear me?
Yeah, now it's clear.
I'm sorry. I only wanted to say that I was in Delhi a couple of weeks ago. I engaged with the Ministry of Commerce and the Ministry of Finance. They are both willing to listen to us for our, shall I say, really trying to simplify and make things easy. So if we can give them something concrete, I would suggest, like Rajan already mentioned this in his ending remarks. I'm just trying to reiterate what he said. I want to quickly follow that up. So even if the people who have heard today, if there are a bunch of suggestions we get, we would be very happy to take it forward, internally, so come to a common set, and very quickly in the next 10-15 days, go to Delhi and give them a set of recommendations.
Thank you, Samir bhai.
But I really thank everybody today. This was remarkable success. And real greater success will be if we can make life also easier and, compliance and ease.
And support the charity.
Yes, absolutely. Somebody is asking where should you send the recommendations to. So do we have an email address that we can give them where to send?
No, let it come to any organization, we'll coordinate.
Okay. But I think an email address would be, all the participants, we will send you all an email. Whoever has participated, we will send you all an email where to send the email, your suggestions. How's that? Okay. Thank you.
With this, we'll wind up this course. But before that, I should thank IMC team led by Upendra Bhai to manage this program very well. Thank you.
Virtual participants can join lunch at their home and others can join here.